Power General Rate Case proceeding. Welcome to a day I hope none of you are superstitious. This being Friday the 13th, we hope it goes smoothly today. And right before we went on the record, Ms. Schmidt made a request that her witness, Mr. Jones, who was going to be scheduled for the second witness today, be moved to go right before Mr. Coleman on the 16th of December. And I don't suppose anybody has an objection to that, and seeing none, that we'll make that adjustment in the schedule. So let me talk about how I have it laid out and make sure everybody is in agreement on this. We'll first of all have Rocky Mountain Power call their last witness, which would be Mr. Eller, and then we'll have the three witnesses that have to go today, Williams, Gorman, and Fitzhenry. What a second, I'm on the wrong day. I apologize. As soon as I said Fitzhenry, I knew I was on the wrong day. Wow. All right, well, let me go back. I was right as of Eller. And then we're going to go to the four witnesses that have to be called today: Vasta, Woolridge, Lynn, and Higgins. And then we'll do Kelly, Boothman, and Mitchell if we can get through all of them today. All right. Does that sound fine to everybody? Okay. Is this Ms. Smith doing this witness?
Yes.
Okay. Would you proceed?
Yes. The company would like to call Mr. Eller as its next witness.
Thank you. Mr. Eller, welcome this morning. Would you raise your right arm? Do you solemnly swear the testimony you're about to give in this matter pending before the Public Service Commission of the State of Utah shall be the truth, the whole truth, and nothing but the truth, so help you God?
I do.
Thank you. You may be seated. Turn the time to Ms. Smith.
Thank you. Mr. Eller, can you state and spell your name for the record?
Yes. Craig Eller, CRAIG ELLER.
Thank you. Can you briefly describe your role with the company?
Yes, I'm the Senior Vice President of Resource Strategy and Development. I'm responsible for all of our very large load requests, as well as all of our generation resource development efforts.
Okay.
Generation and resource development efforts. Sorry about that.
Did you cause to be filed direct rebuttal and surrebuttal testimony in this proceeding?
I did.
Do you have any changes or corrections?
No.
And if I...
I did.
Did you catch all that, or do you need me to back up at all? Okay.
Okay.
Okay. If I were to ask you the same questions, would you provide the same answers?
Yes.
Right now, I'd like to move for admission.
Test. Okay.
Okay, here we go. At this point, I'd like to move for admission for Mr. Eller's direct rebuttal and surrebuttal testimony.
Okay. Without objection, those items of testimony.
Thank you. Did you provide a summary today?
I have one prepared, yes.
Please proceed with that summary.
Good morning, Chair Fenn, Commissioner Clark, and Commissioner Harvey. The purpose of my testimony is to describe the new Voluntary Renewable Energy Credit, or REC, option tariff, a proposed new pilot program where customers can elect to have the company retire RECs on their behalf. I'll refer to this as the REC option program, or just the program. The objective of the program is to help Utah customers meet their sustainability goals with the renewable resources that are already a part of the company's diverse resource portfolio. My testimony provides the details of the program, including program design, enrollment process, and REC retirement on behalf of participants. The voluntary program will offer the company's Utah customers on certain rate schedules the opportunity to have Rocky Mountain Power retire RECs on the customer's behalf from the company's owned and contracted renewable resources. This allows program participants to report a portion of the renewable attributes from the company's Utah allocated resources associated with their purchase of electricity and allows customers to achieve sustainability goals. For customers who select this option, the company will retain RECs for retirement based on a percentage of their aggregated load data in the calendar year immediately preceding the program year and based on Utah allocated company RECs. The company will retire these RECs and participating customers will know the percent of their electricity that can be supported by the program's REC retirement report from the Western Renewable Energy Generation Information System, or REGIS. Participation in this program will require customers to forgo revenue credits in their rates from sales of company-entitled RECs from the RBA. Initially, the company recommends that participation be limited to non-residential customers to minimize the administration of the program. The company may consider opening up the program to customers on other rate schedules at a later date. As a result, no administrative fee is being proposed at this time. The proposed voluntary REC option program offers Rocky Mountain Power customers the opportunity to elect to forgo REC revenue credits in their rates and exchange have system RECs retired on their behalf to support their sustainability goals. This program was developed in response to customer requests and interests in a way for them to meet their electricity needs with the renewable resources already included in their rates. Approval of the program, starting with larger commercial and industrial customers, allows the company to learn from the program without incurring large incremental administrative costs and imposing an administrative fee, while allowing for future expansion to other customer classes. I recommend the Commission approve this program as proposed.
Thank you. This witness is available for cross-examination.
Okay, thank you, Ms. Smith. Ms. Schmidt, are you asking the questions here?
We have no questions.
Oh, okay.
Mr. Greek, you will be handling most of the witnesses today.
Okay, thank you.
Thank you.
Mr. Moore,
No questions from the OCS, thank you.
okay. Ms. Caviglia?
No questions, thank you.
Ms. Hayes, you've moved seats. I assume that may mean you have more cross today.
I have direct today.
Oh, that's right, you do in a bit, don't you? Do you have any cross here?
I would like to ask one clarifying question. When you say recommend the program as proposed, do you mean in your rebuttal testimony as opposed to as proposed in your direct testimony?
That's correct, yes.
Great. That's all. Thanks.
Okay, and it's consistent with what we talked about yesterday. I'm going to assume no one else has any cross unless you, what's that?
Unless they're waving.
Well, you know, some have waived cross, but if they've got a question they want, they want to ask the witness, you just let me know. But we'll just save a little time here. Okay. Well, we go to Commissioner Harvey next.
Just a couple of clarifying questions so I understand what's being proposed. Currently, the RECs that are allocated to Utah Pacificor sells those, and a portion of that revenue minus the percentage Pacificor keeps is returned to Utah ratepayers, correct?
That's correct.
So in this case, the RECs that are retired obviously are used up and they're out of the pool now. So that foregone revenue, how does that foregone revenue relate to the increase in rates that the participating customers would pay?
Yeah. So the way I think of it is, all the revenue from the REC sales, basically creates a pie, which is divvied up between each of the customers, allocated out to them on a pro rata share, right? So each customer gets their share of the revenue of all of the Utah RECs. Going forward with this program, we will set aside a number of RECs, which is, based on the customers opting in, their load. And so it's roughly a proportional amount of RECs that we will set aside. We will not sell those RECs. The pie, if you will be smaller, and then it will be shared across a smaller set. So as a participating customer in this program, you forgo receiving any of those credits on a going forward basis. So all the RECs that we do sell still get credited to those customers that have not opted into retiring their RECs.
Yeah, I understood that. I guess what I was wondering was, conceptually, those numbers should be pretty similar. I guess I'm asking are they exactly the same mathematically, or is it just, I'm guessing how much precision is there going to be in the rider?
Yeah, so to help reduce the administrative aspect and to be able to continue actively marketing the RECs of the customers that aren't voluntarily, participating, we want to have a stable number of RECs. We want to know how many RECs we need to set aside. So we're going to use the customer's prior year actual load. So to the extent that their load is not stable year to year, there could be some minor variation, but by having that be a discrete amount, we can still actively sell those RECs that are available for sale.
Well, yeah, let me rephrase. What I'm interested in is the idea that they'll participate in the program, and I'm assuming as soon as they opt in, they start paying a bit more because they're foregoing potential revenue.
On January 1st of the program year, so they will enroll up through, I believe it's September of the prior year, and then starting January 1st, they'll forgo those REC credits. So in that program year, so in calendar year 2026 as the first program year, they would be forgoing that credit and having higher costs for participating.
Right, but you won't have sold the RECs on the market at that point in time, correct?
So
You meaning the company.
yeah,
Sorry.
sure. So we'll know who's participating the end of 2025. So throughout the year of 2026, we will know how many RECs need to be set aside and not marketed through the normal kind of RFP sale process that the team does to
Right.
monetize the RECs.
But you won't know what this,
Monetize the RECs, sell the RECs.
but you won't know what the selling price is at that point.
We will not know we won't know the ultimate sales price. That's correct.
So how do you set a rate that keeps other ratepayers held harmless?
They're so the RBA tracks all of the sales of RECs. There's a base set, on expectation, and it's trued up each year, but they're exempted, or they're waiving their credits in that program.
Right, but their rates aren't trued up. The participating customers in this program, they're gonna start paying a rate in January. Sometime during the year, Pacificor will make a sale, and that may or may not match the rate that Pacificor set up for those customers.
Yeah, I'm not sure I'm following, because whatever that rate is, and then through the true-up process and the RBA, they are not going to receive that amount, right?
Right, they're not gonna receive it, but in order for the non-participating customers are giving up revenue by the creation of this program, correct?
I don't believe that they are, because the number of RECs that we're setting aside is proportional and representative of only the voluntary participants. So if I, as a customer, in my load usage, had expected the equivalent of, 10 RECs over the course of the year as kind of my value, and my neighbor opts in and we don't retire the 10 RECs for them, my 10 recs are still available for sale, and I will get that value in the rec credit going forward. So, the recs that we're setting aside are intended to be representative of what proportion of the load that voluntary program participant represents. And kind of back to my pie analogy of, you know, the pie gets slightly smaller based on the customers that opted out, and then it's divvied up between a smaller subset of customers. That subset of customers ultimately gets, you know, the same amount of pie in my, I guess, analogy that I boxed myself in on, so.
All right, thank you. I think I understand your position.
Commissioner Clark?
I don't have any questions, but I would like some pie.
Yeah.
Okay, I have just a couple of questions. I just want to understand the initiation of this program and the restricted size of it. So at present, you're proposing there'd be a class of customers totaling about 17,223 that would be eligible for the program.
Right, largely our commercial and industrial customers.
Right, and one of the reasons I think that you limited to that class is concern about scope and administrative costs, is that correct?
That's correct.
There was a proposal that this be considered as a 2-year pilot program. You said you had no problem with it being a pilot program, but recommended it be a 3-year pilot if a pilot program was ordered. And the reason for that is that would give you more time to evaluate the data. Is that correct?
That's correct.
If you then evaluated the data and decided to continue the program, what would be your next step as far as making it available to more customers? Would you make it available to the other 1,044,000 customers in the state, or would you go to another customer class before you went to, say, residential customers?
I don't know that I could say definitively. I think.
Have you had some discussions about it and have some thoughts about it?
We've had discussions. I think, you know, it will be interesting to see what level of participation we see in the program. You know, if there's, let's say, overwhelming interest, you know, at some point you may say, well, when does that become more of the policy? And because there is a balance on, if I'm trying to maintain both sales and retirements, that may add administrative costs that maybe I can avoid if all of the customer interest says, you know, no, we don't want to sell recs, we want to retire them. That might be the administratively best option. Long ways to go to make that determination, but, you know, those are the types of things we'll look at. Where if participation is, you know, relatively modest, you might say, okay, let's expand this, let's add, you know, some customers. We don't think there will be a lot of administrative costs there, but we can keep monitoring it and saying, like, what is that right balance of retirements and sales based on customer interest?
So, is it correct to say that you began this program because you had some customers that were concerned about meeting their own sustainability goals that approached you about it?
Yeah, that's correct. I don't know if you want me to elaborate on that, but, you know, we have different programs available to customers today. You know, we've got the subscriber solar program, we've got the Blue Sky program, which you know, is at an added cost. And we've got, you know, for larger customers, Schedules 32 and 34 to go out and make long-term commitments to specific new resources. But we heard a lot of interest from customers in, hey, we know that there's a growing mix and portion of our load that's coming from renewables today, but for my specific, you know, reporting requirements or the way I think about renewables, if you're selling those recs, you know, I can't take credit for it in kind of my corporate reporting or, whatever that is. And so this gives them an option to say, no, these RECs are being retired. I can, view my energy mix as consistent with the portfolio that Rocky Mountain Power has.
Okay, I understand that. I think that's helpful. And as far as marketing or administrative costs, you've got a subset of customers that are interested in this. Are you anticipating, what do you anticipate a range of administrative costs? Are you going to actively market the program and incur costs there, or is this going to be more like just based on relationships you have with these customers? How do you intend to market it, and what type of administrative costs do you foresee?
Yeah. We don't intend to do like an active marketing campaign. It being the larger kind of commercial industrial customers, we do have a lot of ongoing discussions with them. And so as they express to us, interest in hitting certain sustainability goals, this is just one more tool that we can offer to them, to help them meet their goals. So that's how I would see kind of this program growing over time. And again, because of that, we're not anticipating, a large administrative cost that, we need to track.
So it just kind of grows organically through the relationships you have with these existing larger customers, and word gets out and you talk to them about it and so forth.
That's correct.
So no real other administrative costs associated with this program.
That's correct.
That's fair, okay. I have no other questions, thank you. Mr. Eller, I think that will conclude your testimony. That was pretty painless, wasn't it?
It was, yeah, thank you.
On a Friday morning. Okay, thank you. Okay, I already had my first jinx earlier this morning on the Friday the 13th. So now we'll go to the witnesses that are scheduled for today. Mr. Vostok. Vostok, how do I pronounce that?
Vostok.
Vostok.
Vostok?
Vostag?
Yes. Bela Vostok.
Yes, okay.
We would prefer to have Dr. Woolwich testify first. I raised this with Rocky Mountain Power before, and they had no objection.
Just so we know, you didn't raise it with me, and I have no objection to it, but I didn't realize that was the case. But that's absolutely fine. That's great. Let's have Mr. Woolridge testify.
The Office of Consumer Services calls Dr. J. Randall Woolridge to the stand and asks that he be sworn.
Thank you, Mr. Moore. It's Dr. Woolridge, is it not?
Yeah, I guess.
Why don't you just stand there for
Pound
one?
higher and deeper, you're right.
Well, listen, meet Dr. Harvey right here.
Is that right? We've been through this before. Yeah.
Would you raise your right?
Yeah.
Dr. Woolridge, do you solemnly swear the testimony you're about to give in this matter shall be the truth, the whole truth, and nothing but the truth, so help you God?
I do.
Thank you very much. You may be seated.
Dr. Woolridge, could you please state and spell your name for the record?
My name is the initial J, Randall Woolridge, and that's spelled Woolridge.
For whom are you testifying today, and what is the subject of your testimony?
I'm testifying for OCS, and I'm testifying about Rocky Mountain's cost of capital.
Did you prepare and cause to be filed on October 17, 2024, direct testimony and accompanying exhibits, and did you prepare and cause to be filed on December 4th, 2024, survey-well testimony and accompanying exhibits in this case?
I did.
Are there any changes or corrections you'd like to make to your testimony at this time?
I have an edit sheet that I prepared. As I was getting ready to prepare testimony, a new value line came out. So I got the value line in my data analysis. There were a couple of places in my testimony where I didn't get the updated data. So they're all changed by a tenth or two, but there's like 6 or 7 of these. So I made an exhibit just so they're all laid out. And it's, by page, line number, and edit.
Okay, That's, I think that's fine. You want to talk about and then try to admit that exhibit now or wait until after his summary?
I think I'll move to admit it now.
Okay, that'd be fine. Would you describe it just a little bit more?
Yes, it's a simple page with the name of the case on the front, OCS hearing exhibit number 1, and then there are pages and lines and corrections.
Okay, all right.
May I approach?
Please, you can distribute that.
These all apply to the direct testimony. I imagine.
Yeah, we'll ask that question. Mr. Moore, Commissioner Clark's asked, this is all applicable to the direct testimony, is that
Yes.
correct?
Direct
Okay,
testimony.
so Dr. Woolridge, you're the better one to answer that question. Okay, we're ready for a motion to admit this.
I'll move to admit the OCS hearing exhibit number 1.
Which, as I understand it, are simply edits to change some percentages, either up or down, in his direct testimony.
That's correct.
Any objection to that being admitted?
Well, yes, I think that some of these are not minor changes, and I have not gone page by page through these, and really, I need Ms. Bulkley kind of to tell me, is there something of significance here? Here's what I would propose.
Okay,
I would propose that we allow him to proceed with his testimony and that he be subject to recall later in the day, and that I get the opportunity to get this to Ms. Bulkley and have her tell me, are there things here that are of significance we need to make a point of or not? If there aren't, no big deal. We don't need to worry about that.
Commissioner Harvey, I'll get to that in just a second, Mr. State, but Commissioner Harvey asks, these are changes in your direct testimony, but are these percentages already in your rebuttal and surrebuttal
Well,
testimony?
yeah, they don't pertain to my surrebuttal, just to my direct, to those couple pages. It was a data update at the very last minute, so it's just in my initial testimony, not, in my surrebuttal, I had other data that I used.
Okay, got it. And that's publicly available sources
Yes.
that were updated, and so you use that latest information to update your percentages in your direct testimony?
Yes, and they were in my work papers.
Okay. Mr. Moore, would you like to speak to Mr. Sabin's objection before I rule on it?
No, I believe that the changes aren't significant, but if he wants his witness to review that, that would be fine.
Yeah, that's what I'm going to rule. I think it's fair. We'll allow Dr. Woolridge to go forward. We'll hold in abeyance a decision on the admissibility of this exhibit, OCS hearing exhibit 1, until you've had a chance to confer with Ms. Bulkley, and then you can report to us later if we need to recall Dr. Woolridge. Are you available throughout?
I have a flight a little later, so I don't know.
What time was your flight?
It's like 1 or 2, so.
Probably ought to see if we can get a hold of Ms. Bulkley and see if we're going to have any problem with it before then.
Well, I could join it by Zoom next week if there's an issue.
Okay, we'll figure it out then.
Robert, do you by chance have an electronic version of this you could email me that I could send expedited to Ms. Bulkley? That might speed things up there. If you don't, it's okay, I can have somebody go scan it, but.
Yes, I don't have one, but the
Somebody can get it to
OCS
us.
will email it to you.
Okay, we'll just ask you to try to expedite a decision on this if we can. Well, if we need to have recall Dr. Woolridge, we can do it while he's still here. But I suspect at the end of the day, we're probably going to be fine on this, but we'll just have to, we want you to have the opportunity, subject to your checking with your expert, with your witness.
Thank you.
Okay, but you can proceed when we can. Yes, we have an incredibly capable person on our staff who can correct any errors that all of us make. And on, let me see your version. So Melissa's just informed us that on page 54, line 1172, that's not accurate. I want to look at that. But that's not going to, just make a correction if you need to, and look at that.
I'll look at that, yeah.
Yeah. We'll give that to you, Dr. Woolridge. You can look at it and see if it's right.
Thank you.
Okay, but having now gone through those many iterations of this one-page document here, we'll proceed. Let's continue.
Other than the changes we have been discussing, if I ask you the same questions as exist in your written testimony, would your answers be the same?
Yes.
Move to admit Dr. Woolridge's testimony and exhibits.
Without objection,
No objection.
it is admitted. Thank you.
Have you prepared a summary of your testimony, and would you like to provide it this time?
Yes.
Please proceed.
Okay. The company has proposed a hypothetical capital structure with a common equity ratio of 50%. The company's ROE witness, Ms. Ann Bulkey, has recommended a return on equity of 10.25% to 11.25% for Rocky Mountain Power. However, RMP has elected to propose an ROE of 9.65%. The company's overall rate of return proposal is 7.43%. RMP's proposed capitalization has more equity and less financial risk than the utilities and the two proxy groups. In addition, the company's common equity ratio has declined from 50% to 42.2% in the last year due to Pacific Coast wildfire losses in Oregon. I provided a study on RMP's capital structure and employed a capital structure for RMP with a common equity ratio of 47.5%, which is about halfway between RMP's proposed common equity ratio of 50% and the company's current equity ratio of 42.2%. I have adopted the company's long-term debt and preferred stock cost rates. I have applied the DCF and CAPM models to two proxy groups of electric utilities, my group of 24 electric utilities and Ms. Bulkey's group. My analysis indicates an ROE in the range of 8.4 to 9.7% for the two groups. Since I rely primarily on the DCF model and RMP's investment risk a little below that of the average of the group, I recommend an ROE range of 9 to 9.75%. Given these results, I'm recommending an ROE of 9.375 and an overall rate of return of 7.19%. The primary ROE issues in this case are, number one, the capital structure, which I just mentioned. The proposed hypothetical capital structure has a higher equity ratio and lower financial risks than electric companies. Number two, RMP's investment risk is a little below the average of the two groups. RMP's S&P Moody's ratings of BBB plus and Baa1 are slightly above the proxy group averages of Baa plus and Baa2. Number two, the DCF approach. Ms. Bulkey and I both applied the DCF approach to our proxy groups. The biggest issue with hers is she relies exclusively on the EPS growth rate, earnings per share growth rate forecast of Wall Street analysts and Value Line. By contrast, to develop a DCF growth rate, I have reviewed 13 growth rate measures, including historical projected growth, growth in dividends, book value, and earnings per share. With respect to the CAPM approach, requires an estimate of the risk-free rate, beta, and the market risk premium. Ms. Balke has made two errors. First, she's used the empirical capital asset pricing model, which is a ad hoc version. Yeah, I'm sorry. Empirical capital asset pricing model, which is an ad hoc version of the traditional capital asset pricing model. But most significantly, she's employed a market risk premium of 7.86%. This 8.6% market risk premium is much larger than those indicated by historic stock and bond returns and found in published studies and surveys of the market risk premium. In addition, I demonstrate that her 7.86% market risk premium is based on unrealistic assumptions about future earnings and economic growth and stock returns. Specifically, I highlight her market risk premium. She assumes that the S&P companies can grow their earnings per share, at over twice the projected GDP growth rate of the United States. On this issue, I've quoted Milton Friedman, Warren Buffett, and Jeremy Siegel saying that over the long time, corporate earnings can't grow faster than GDP. My market risk premium, on the other hand, uses three different approaches: historic returns, surveys, and expected return models. I've used a market risk premium of 5%, which is consistent with the published market risk premiums by leading finance scholars, leading investment banks, and found in surveys of companies, analysts, and corporate CFOs. Ms. Balke has also used an alternative market risk premium model, which is based on the historical relationship between authorized ROEs for electric companies and 30-year treasury yields, and she computes an, 30-year treasury yields. And she computes the estimated ROE as a projected risk-free rate plus her market risk premium. I cite my testimony. There's three problems with this. Number one, it reflects commission behavior and not investor behavior. Number two, the risk premium produced is inflated because electric utilities have been earning ROEs above their book value, or they're selling at market. The book ratio is greater than 1 for many years. And thirdly, it's dependent on the authorized ROEs for state commissions, and I cite the Warner and Jervis study and other recent studies which show that authorized ROEs over the past 4 decades have overstated the actual cost of equity because they've not declined with the declining capital costs. Ms. Balke also considers several other factors, business and regulatory risks, namely wildfire risks, the company's capital expenditures, and regulatory risk. Most significantly, I highlight that the S&P Moody's ratings for RMP are slightly better, and as a result, these are factors that are already considered in the credit rating process, and there's no reason to make adjustments for these factors. In addition, I note that Utah has been very proactive in dealing with wildfire risk, and in the end, neither Ms. Balke or I make an adjustment for wildfire risk, so there's no need to make such an adjustment. In my survey rebuttal testimony, I identify a number of issues highlighted by Ms. Balke in her rebuttal testimony. I've updated the capital market conditions and talked about the election and the impact or potential impact on capital costs. I've dealt with the other issues that are differences of opinion in this case. I've also updated my ROE and cost of capital based on after election capital market results. My overall rate of return recommendation is 7.19%.
Dr. Woolridge is available for cross and questions from the commission.
We'll go to Mr. Saban.
Thank you, Mr. Chair. Hello, Dr. Woolridge. Good to see you again.
Yes.
I think I'm hoping I can start out with some really easy stuff that we won't disagree with, and, when we.
I do too. I like
Yes,
that.
that makes it easy, right?
Yes.
I just want to make sure for the record, we're clear on what your overall recommendations are. After your surrebuttal was filed, your current recommendation for the company's return on equity percentage is 3.75%, is that right?
7.375%. I mean, 9.375%.
Correct,
Yes.
correct, okay. And your overall, the updated overall rate of return you recommend is 7.19%?
Yes.
And then the capital structure you recommend has an equity position of 47.5%, correct?
Yes.
Okay. And in that respect, you have elected not to use the historical, or sorry, the actual capital structure of the company, correct?
Well, yeah, I think it was, as of the last data I had, it was about 42%. No, I've used something between that and what the company has proposed.
Right, thank you. And I take it, if I'm understanding your surrebuttal testimony correctly, the reason you updated these numbers from what was in your direct was because of changes in the economy. Is that a fair statement?
I think, yeah, I mean, obviously, since the election, the stock market has done extremely well. Interest rates jumped up, then they went back, and now they're jumped up a little bit. Obviously, there's always a lot of expectations about, economic growth and a more business-friendly administration. But again, I think there's a lot of uncertainty just because there are a lot of things that were proposed during the election that may or may not come about, depending on how things work through Congress. So I think it's tough to get a real good understanding of where things are going to go. There's lots of statements made during the election that, it's been stated that within a year, electricity prices will be 50% of where they are on day one, which it was, one of the things that investors hear, but we'll see how it develops. So I think it's, difficult to tell what's going to actually happen. So I updated it, but again, it's going to depend on how a lot of these things develop.
Are you trying to suggest that all the things politicians told us during the election cycle will not come to fruition?
No, as being a college faculty, I have to be very, I'm nonpartisan. We never talk
I'm
politics.
just playing, so. All right, the percentage you had for the company's ROE in your direct testimony was 9.25%, correct?
Yes.
And then, I'd like do you have your surrebuttal testimony there with you?
I do.
Would you open up to page 2, line 41 of your surrebuttal testimony?
Yes.
And just to note, that's where you make the change from the prior recommended ROE to the 9.375%, correct?
Yeah, I think it's on line 45.
Right, correct. 44 and 45 is the sentence
Yes.
there, right? Now, both the 9.25% in your direct testimony and the 9.375% in your surrebuttal testimony, those are both higher numbers than you used in the 2020 Rocky Mountain Power rate case proceeding, correct?
Yes.
In that proceeding, and I have your testimony if we need to go to it, if you remember it, I show that you recommended at that point in time a 9% ROE, is that correct?
I recommend in that case 9% with a 50% equity ratio. If the commission adopted the company's proposed equity ratio, I recommend 8.75%.
And in this case, do you agree, I think you and Ms. Bulkley agree that there is a relationship between the capital structure and the ROE, is that true?
I generally believe yes.
And can you just briefly describe what you understand that relationship to be?
Well, it's going to depend on the perceived risk of the capitalization. Certainly, you use more debt, you're going to be riskier. It will be reflected in your credit ratings. And that would presumably make, if the credit ratings were significantly different than the proxy group, then I would make some type of adjustment for that.
So, I'm not asking that you acknowledge some sort of one-to-one relationship. Generally speaking, if the equity share of the capital structure tends to go down, you are riskier and therefore your ROE tends to be a little higher. Is that a fair statement?
Yeah, yes.
Okay. So I take it since in 2020, you recommended a 9%, and I understand that there's an alternative there, but you recommended a 9%. And then earlier this year, you recommended a 9.25%, and then now you've got a current recommendation of 9.375%, that you agree that the cost of equity since since the year 2000 has increased.
Oh, yeah, I mean, authorized, on the fourth quarter of 2020, the long-term interest rate hit an all-time low of 1.3%, that 30-year treasury yield. That was also the year of the lowest authorized ROEs in the country for electric and gas companies. So, generally, yeah, interest rates move down, authorized ROEs move down.
Right. And you noted in your statement that the company is asking in this case for a 9.65% ROE, correct?
Correct.
And that was, in fact, the commission authorized ROE from the year 2000 general rate case, correct?
The year 2020 rate case, yeah.
Sorry, I meant
Yes.
2020. Yes, thank you. So you would agree, would you not, that if we take that the commission authorized an ROE of 9.65 in 2020, and the conditions in the market have changed such that the cost of equity has gone up, I'm not suggesting that you have to agree that 9.65 was the right number in 2020, but if we take the premise that the commission determined that the authorized ROE in 2020 was appropriate for the company, one would expect, would you not, that the ROE would increase between 2020 and 2024?
I agree you would, because obviously interest rates gone up and that sort of thing. I think we're anchoring on the 9.65 in the fourth quarter of 2020. As I said, authorized ROEs, 30-year treasuries hit an all-time low in the fourth quarter of 2020. The 9.65% the commission said was based on gradualism, that sort of thing. It was also one of the highest ROEs in the country for electric utility in the fourth quarter of 2020. And that's because the commission recognized that they were using gradualism, so their ROEs never went down nearly as much as interest rates did.
They were using gradualism, so
In the order, the commission said in the order that they were using gradualism in terms of moving from the 9.8, which was the previous ROE, to 9.65, and they used gradualism as the reason. They identified my testimony and others that said we were too low.
Right, and that was where I was going. The commission actually, in that decision, said that they believed you were too low in that case, right?
Yes.
So I'm going to have my colleague, Mr. Moskin, pass around an exhibit. I thought this got admitted, but I couldn't find it in the record. So I'm just going to, for the sake of expeditiousness or expediency, going to do it this way. And if we've got two of them, we'll take one out. While he's passing that out, let me just characterize what this document is first. You may not have ever seen this, Dr. Woj. I can't remember if you reference it in your testimony. This is an order from this commission in the Dominion Energy Utah general rate case from December 23rd, 2022. So you should see that it's a packet that has, it basically is about a 51-page decision by the commission with some attachments there too, okay? Do you have that document there?
I have it.
Okay. I couldn't find this being admitted, but I moved for its admission here, and so I can use it.
Yeah, I thought it had been admitted, but I don't see any problem. We'll just admit it as RMP Cross Exhibit
1.
1.
I have a slight clarification.
Sure, Mr. Moore.
I believe Mr. Saban said that there were some exhibits to it. I don't see any exhibits to it.
I said that in a sloppy way. What I meant was that near the back, they stopped numbering the pages. I just meant, or I guess they do, it's just on the side of the page, excuse me. I didn't see that they did.
There's some charts starting at about page 53. and they are numbered at the, right below the docket number. So, is there any objection to me admitting this? Okay, we'll admit RMP Cross Exhibit 1.
Mr. Chairman, I'll just point out, I think this is the same document as DPU Cross Exhibit 9.
Okay, yeah, I thought we'd admitted
I
it,
couldn't
but
find it,
it
but,
doesn't matter. We've admitted it now, and you can use this document that's in front of you.
All right, Dr. Woolridge, would you turn to page 7 with me, please?
I'm there.
We're gonna go to the middle paragraph that starts in February, and I'm gonna skip down just one line, and I'll read the sentence that, or the sentences that I wanna ask you about. This order states that our evaluation in this case considers, among other things, the extent to which financial conditions have changed since that decision, then they're referring to their 2020 decision, and the impact those changed conditions should have on DEU's authorized ROE. There is no real dispute that financial conditions have changed since February 2020. As identified by the parties, the impacts of the COVID-19 pandemic, the actions of the Federal Reserve, and perhaps other issues such as the conflict in Ukraine have resulted in higher inflation rates, higher interest rates, supply chain disruptions, and other issues. So let me just stop there first and just note, you would agree, would you not, that in 2024, we do have some of these same persistent challenges. In fact, the interest rates right now are at much higher levels than they were in 2020 or in 2022, correct?
Interest rates have increased, yes.
Yeah, okay. And we have had very, very high inflation rates since 2020 to now. Is that, would you agree with that?
Yes, and I discussed that in my testimony.
That's why I said I don't think we're going to disagree about a lot of this
Right.
initial stuff. And understand that. And just want to note that, do you have an understanding of that the commission in this decision is noting that it starts with the ROE that was previously awarded and adjusts from there?
Yes, it's, in the world of finance, we call that anchoring.
Yes.
And if you notice, that previous ROE was in February of 2020, which of course was the month before COVID hit.
Right.
So, yeah, it didn't have any COVID effects in it, but yes, I agree with you.
Okay. So now, sticking on the subject of the ROE, I take it you have reviewed the decision, the recommendations of the other experts on the same issue in this case?
Yes.
You have a binder there in front of you. I put it there this morning. And if you could just find Mr. Lynn's testimony. He is the witness for WRA, and I believe he's there near the front of that document, so, or that binder.
Anderson, I see one for Anderson, Ramus, Anderson, Ramus, Vastag, Woolridge, Higgins, Mitchell, Garrett, McGovern, Boothman, Kelly, Lynn.
There we go. So instead of being at the front, it was at the very back.
It was the very last one.
Thank you for your patience. I thought it was the other way around. I was probably looking at the wrong way on the binder. Do you see Mr. Lynn's direct testimony there?
I do.
Okay. Would you please open up and turn to page 26.
Yes.
And we're going to go to lines 429 to 430, let's see. Yes, 429 to 431. Do you see that?
Yes.
He states the general utility industry cost of equity according to the NYU Stern analysis in the latest January 2024 issue is 6.55%, or 47.4% lower than Pacificor's current and requested ROE. Do you see that?
Yes.
Now I'd like you to flip to your direct testimony, and there is a chart in your testimony on page 21 of your direct.
Yep.
I take it, sir, and I'm assuming something here, but the table 3 down toward the bottom 2/3 of the page,
Yes.
that you prepared that after reviewing the ROEs that have been authorized by for electric utilities from 2010 through 2024. Is that a fair statement?
Yes.
In your work in reviewing ROEs during that period of time, have you ever become aware of any commission that has awarded or authorized an ROE at 6.5% during that period of time?
No.
Based on your experience, are you aware of any commission ever awarding an ROE of 6.5%?
No, I'm not.
Do you agree with Mr. Lynn that the statement that we just read a moment ago, that according to the NYU Stern analysis, that the general utility cost of equity is at 6.55% in 2024?
No, and, I'm very familiar with what they do at Stern. The Modern's behind a lot of it. And a lot of numbers are like that, or
She wants you to.
Stern. No, I'm sorry, I'm very familiar with what they do at Stern in terms of their financial analysis, that sort of thing. Their numbers are low, and it's like, they're low mainly because, and it's true, is if you look at Wall Street uses, they use much lower numbers than authorized ROEs. I mean, I'm very familiar, given my position, about what Goldman Sachs and the others do. And their numbers are much lower, and the reason is obviously interest rates still are relatively low. They use much lower market risk premiums than what we see in here. So their numbers are generally low. And one reason it's true is because utility stock prices are high. The higher the price you pay to get in, the lower the expected return. And that's why market risk premiums in commercially available sources have gone down, because stocks have up 30% this year. Utilities are up 30% this year. When the price goes up, the expected return goes down because you're paying a higher price to get in.
Now, would you turn to Mr. Lynn's surrebuttal testimony, which should be just after the direct testimony I had you read from a moment ago?
I'm there.
We're going to go to page 7.
Okay.
And we're going to go to line 93 right at the top of the page, and I'm
Yep.
going to read there. It says, at a minimum, the commission should note the cost of equity average for the entire market is 8.48%, according to the NYU Stern analysis. Let me just stop there. My understanding is you would also not agree with that statement, that you don't believe that the cost of equity average for the utility market, for the entire market is 8.48%. Is that correct?
No, I mean, but I understand if you use risk premium models and use risk premiums that are what Wall Street uses, you're going to get numbers below 9%. I would say my numbers certainly higher than what Wall Street firms use. And DeMotor's analysis is all tied to a market risk premium that's very sensitive to market prices.
Right.
So that's why those numbers are low right now, because the market has done well. And as a result, market risk premiums are lower.
Right, but suffice it to say, you're obviously recommending an ROE here higher than either of those numbers. And I take it the reason you have done that is you don't agree that those percentages or those analyses would be appropriate for what we're doing here.
No, and in my study, in my testimony, I have a study of interest rates and authorized ROEs, and basically demonstrate that ROEs never declined like interest rates did during 2020, 2021. Interest rates went down 150 basis points, authorized ROEs went down 30 basis points. Commissions never adjusted ROEs to reflect capital market conditions. So now that interest rates have gone up, you know, you're not seeing authorized ROEs go up nearly as much, and that's in the study I have in my initial testimony.
All right, let's change topics now and talk about the discounted cash flow model, or DCF model, which both you and Ms. Bulkley use in your analysis, correct?
Yes,
Could you do you have Ms. Bulkley's testimony there with you?
I think I do. Yes,
All right, would you turn to page 33 of her direct testimony, please?
I'm there.
Down on the bottom of the page, there's two equations. Do you see those on that page?
Yes,
There's one that's got a number 2 by it. Do you see that?
yes,
I assume you are familiar with that equation.
yes.
Could you, in layman's terms, the best you can, this is the professor side of you, I'm inviting you to come out. Would you give us in your best layman's terms what that equation is doing?
Basically, it says, under certain simplifying assumptions, the cost of equity capital is equal to the next year's dividend divided by the initial price. So that's a dividend yield using the next year's dividend plus the expected growth rate in dividends over an infinite time period. So it's a long-term growth in dividends, but it's also, you know, earnings, dividends, all kind of presumed under the long-term, under the model to grow at the same rate.
And we often, that is sometimes referred to as the constant growth model, correct?
Yes.
And in the phrase constant growth model, what does the word constant mean?
That means the growth rate's the same, it doesn't change.
Okay, so it would be improper, wouldn't you agree, if the G there, which represents the growth rate, if you use different numbers throughout the analysis for the growth rate?
I don't understand.
The G represents the growth rate, correct?
Yes,
And I think you just said, and I would tend to agree with you if I understand you right, that you're using a constant growth rate,
yes.
not a variable growth rate, not multiple growth rates, you're using one growth rate.
No, some people will use a multi-stage growth rate, so they have a 2 or 3 stage where they say, well, it's gonna grow faster, and then eventually it's gonna slow down and be a constant growth. And I explained in my testimony why I think a constant growth DCF really is applicable to the utility industry due to regulation, that's right. But yes, I agree.
So you would say if you're doing it right, you should be using a constant growth rate, one rate that you have determined to be appropriate for that formula.
Yeah, I mean, it may be right to use that with a utility, and I explain why, maybe not for Netflix, so.
Right.
Yeah,
Yeah, but for what we're doing here,
I agree.
okay. Now I want to talk about the capital asset pricing model for a minute, or CAPM, which you also performed, correct?
Yes.
Can you turn to page 61 of your direct testimony, please?
Yes.
All right. And we're going to go to lines 1323 to 1329.
Yes.
All right. And there you're discussing the concept of the using of betas in the CAPM model, correct?
Yes.
Would you tell me, in the CAPM model, what is the beta coefficient?
The beta measures the volatility of the stock relative to the market. Historically, utilities do their regulation data, they have a beta less than 1. In other words, if the market goes up 10%, they go up by less than 10%, and the beta measures that. Market goes down 10%, it goes down by less than 10%. Because betas tend to be less risky than the overall market, or utility stocks are less risky than the overall market. Here in this thing, I talk about value line, I've used tradition, and I talk about a number of the issues of estimating beta, the time period used, the interval used, whether you use weekly, monthly data, whether you make an adjustment to beta, which value line does, other sources do not. So there's not one refined area. People generally say you regress this and that, but you use past data, so you want to use something you think will be applicable in the future.
Yeah, and I think you said this, but I want to make sure, you used value line in S&P.
Yeah, I used to use value line all the time, but when you start looking at Yahoo with betas of 0.48 for electric utilities and value line of 0.9, and I just started looking at all the different sources. I use Cap IQ. I think a lot of people use that, and that's a pretty well-known source of data. So I added Cap IQ in addition to value line.
Okay. And you agree, I take it, that value line beta coefficients are calculated based on 5 years of weekly returns, correct?
Weekly data. And it's funny, and I explain it here, they use the New York Stock Exchange Index. Well, that's fine, that's only, the stocks on the New York Stock Exchange. It excludes the technology sector, Tech stocks don't trade on the New York Stock Exchange, they're over the counter. So this vast market for tech stocks, which tend to be more volatile in the over market, don't get counted in measuring the market return in their beta.
Okay, thank you. And then it's true, is it not, that the S&P beta coefficients, they're based on 5 years of monthly returns?
Of monthly returns,
from the
yes.
S&P 500?
Yes.
Okay. In selecting beta coefficients, do you agree with this statement? It is important that if multiple beta coefficients are selected, that there be at least one difference in the calculation to ensure that the betas from multiple sources are not identical.
If I understand your question, I mean, obviously you're going to find different ones for Bloomberg, for Value Line, for Yahoo Finance publishes theirs. A lot of sources publish theirs, but you have to read in the notes about what data they use, what are the time interval, that sort of thing. Or are they adjusted or not?
Yeah, you want to have, if you're going to rely on multiple betas, you don't want to be relying on betas that are exactly the same, because that skews towards that methodology, correct?
Yes.
Okay. Now, would you go to do you have Mr. Coleman's direct testimony there?
No.
Would you go to his testimony at page 63?
I don't have his testimony.
Oh, let me. Sure. Oh, should have taken the pen out, sorry.
Okay.
He is, let's see, right here. Right there.
Got it.
All right, again, so page 63, and we're going to start on lines 1621 and 1622.
What?
Sorry, line 1621, right near the bottom of
Yes.
the page. Mr. Coleman states, I have calculated the CAP-M using the beta from Value Line and the average beta as reported by Zacks and Yahoo Finance. Do you see that?
Yes.
Do you agree with me that, given what we just spoke about, that it would not be useful, or in fact, it would be detrimental to be using both Zacks and Yahoo Finance betas in conducting a CAP-M analysis?
I don't know. I haven't looked at Zacks betas, so I don't know kind of all the details of the calculation of Zacks betas. I know Yahoo Finance uses monthly data in the S&P return, 5 years. I don't know what Zacks does.
If Yahoo Finance and Zacks used the same methodology to derive their betas, you would agree with me then that it would not be good to use both of them?
Well, they probably have similar betas, so they'll be weighted. They'll be weighting monthly data more than weekly data.
Just as we just discussed, it would be skewing it towards that
Well,
methodology.
it'd be, certainly, yes.
Okay. All right. Just a couple more topics here. Let me hand you another exhibit. All right, Mr. Moskin's going to bring around another exhibit. All right. I'll describe this while Mr. Moskin's passing this out. These are excerpts from a book that I hope I never have to read called Principles of Corporate Finance. This is, I could have produced the entirety of the book if people want that. I will represent that what we've included here are the cover page, the first page inside the book, as well as page 214 of that textbook. I would move for its admission.
Pardon me?
Yes, go ahead.
Would like to ask a couple of clarifying questions, and I may have an objection.
Okay.
May I address my questions?
Sure.
To Mr. Saban?
Yes.
Mr. Saban, how long is the book?
It's probably a better question for him since I haven't read it and I got it from my expert, but my understanding is it's a very lengthy book.
How long is very lengthy?
More than 214 pages. So the book itself is, I can get the exact page numbers, I don't have them here. My understanding, though, is this is a very common, and I'm happy to ask Professor Woolridge here, my understanding is this is a very common, I'm not sure treatise is the right word, but well-accepted book on corporate finance principles.
Perhaps to help us resolve this, we could ask Dr. Woolridge if he is familiar with this book.
Oh, yeah, this is the gold standard for corporate MBA programs.
So,
Really admires.
do you think we should ask Rocky Mountain Power to provide a hard copy to all of the parties in the case?
Electronic copy, perhaps.
No, I'm teasing, but
In all honesty, I just had this very thing come up in a FERC proceeding, and I got chided by the judge for putting in the entirety of the book because, in a copy version, because he said, Mr. Saban, did you just violate copyright law by giving us all a copy of this? So
Fair use.
I'm being sensitive of that as well, in all honesty.
okay, do you have an objection, Ms. Schmidt, to this?
Given the discussion, I have no objection, thank you.
Okay, all right, because Dr. Woolridge is very familiar with this, which is a very commonly accepted finance textbook.
All right, so, Dr. Woolridge, I'm going to draw your attention, and unfortunately, we're going to have to read a little bit here, but I think the actual point I need to make is very brief after that. If you could just refer to the top of the page, starting with the words, you see where it says the company cost of capital?
Yes.
Okay, and I'll spare you having to read this in the record, I'll do it for you, but what this says is the company cost of capital is defined as the expected return on a portfolio of all of the company's existing securities. It is the opportunity cost of capital for investment in the firm's assets, and therefore the appropriate discount rate for the firm's average risk projects. If the firm has no debt outstanding, then the company cost of capital is just the expected rate of return on the firm's stock. Many large, successful companies pretty well fit this special case, including, and there's some examples, I won't read all those, and then there's a paragraph that follows below that. The company cost of capital is not the correct discount rate if the new projects are more or less risky than the firm's existing business. Each project should, in principle, be evaluated at its own opportunity cost of capital. This is a clear implication of the value additivity principle introduced in Chapter 7. And then I'm going to skip down to a paragraph that starts, if the firm, right below there, Dr. Woolridge, do you see that?
Oh, yes.
If the firm considers investing in a third project C, it should also value C as if C were a mini-firm. That is, the firm should discount the cash flows of C at the expected rate of return that investors would demand if they could make a separate investment in C. And this is the line I want to ask you about. The opportunity cost of capital depends on the use to which that capital is put. So here's my question. Do you agree, Dr. Woolridge, that when that investor required returns are dependent upon the use of funds, not the source of funds?
The opportunity cost of capital depends on the use of funds. Well, it's going to reflect the use of the funds because it's going to reflect how risky the investments are that are being used with the funds. So,
And each time you're calculating that you're looking at the project that is under consideration, correct?
You're gonna have to make adjustments for the amount of risk in that particular project you're making.
Okay.
But the cost of capital reflects the cost of funding that investment.
Correct, but it's not, we don't, in that equation that's there on the page in the middle, we're not taking into account the source of the funding for purposes of determining that opportunity cost of capital, correct?
No, but I mean, I disagree, because obviously you look at the expected returns to determine what the discount rate is, and that's gonna depend on the investment you're making on the left side of the balance sheet. So in that way, there is a tie between how you're using it and how you're funding it.
So, with that sentence that I read, you would take issue with the sentence that says the opportunity cost of capital depends on the use to which the capital is put?
Yeah, because that's the risk. The riskier, so if you're suddenly.
When you said yes, do you mean yes, you agree with that statement, or yes, you disagree with it?
I agree with it.
Oh.
And then the cost of those funds is gonna reflect how risky, I mean, obviously, the cost of capital for Netflix is higher than it is for Pacific Corp, right? And as a result, the cost of the funds investing in a new development project, Netflix, is gonna have a higher cost of funds, because investors are gonna charge a higher required return to invest in that versus a public utility.
But that's, yeah, and that's dependent upon, that's because of the manner in which the funds are gonna be used, correct?
Yes.
Okay, thank you. All right, last topic, and this is where I think you and Ms. Bulkley have one of your largest disagreements, has to do with the market risk premium, which you noted in your statement, correct?
Biggest mystery in finance, according to somebody I knew pretty well, Merton Miller.
Mr.
Yes.
Saban, are you going to move off of this book
Yes, I'm
excerpt?
sorry. We don't
I
need
think
that.
we removed the objection, but I don't think we admitted it as a cross.
I'm sorry if I've overlooked that. Can I move to admit this as Rocky Mountain Cross Exhibit 2?
Any objection? Okay, all right, it's admitted.
All right. I have read your testimony on this issue, and Ms. Bulkley's.
Awake?
It was a challenge. We lawyers take a lot of grief about how boring our jobs are. I think we could have a fair competition between the two
Hey,
of
look
us.
at the bright spots, not depreciation.
That's good.
I said, it's not depreciation.
Yeah.
Look at the bright side.
The bright side, it's not depreciation, which I agree, yeah, okay. My understanding, and this is just my lawyer's understanding of the reason you believe her rate, at least one of the reasons you believe her rate is too high, is you believe the EPS growth rate and the GDP rate are directly linked. Is that correct?
Yeah, there's several of them. Obviously, and you look at rate cases all over the country now, the big numbers that are come out are on the CAPM results. You look at Ms. Balke, you look at other testimonies, the highest results come from the CAPM models, and it's all because they all compute the market risk premium the same way. They apply the DCF, discount cash flow model, to the S&P 500, and use analysts' EPS growth rate estimates as the growth rate. And I highlight in my testimony, I show studies I've done that show that over time, these are overly optimistic, upwardly biased, the growth rates. And they produce high expected returns, which produces high market risk premiums, okay? Now, and the difference, the question was, the earnings per share over the long term for corporate earnings cannot grow faster than the economy. Now, you don't have to believe me on it. I cite Warren Buffett, I cite, I forget who else, but I cite, leading scholars over the long term, because corporate profits are a 6% of GDP, okay? And anytime they go up or down from that, usually they turn around, come back to about 6%. So, yeah, we disagree on that. Her model says corporate profits can grow at over twice GDP. I say they don't, and others agree.
Thank you. Let me go back to my question, which was just one of the reasons you disagree with her about that issue you just explained is, in your view, the EPS growth rate and the GDP growth rate are directly linked, correct?
Long term, yeah. And
Yeah.
this is a long-term This is a long-term assumption, you know?
Understand, so, would, oh,
yeah,
go ahead.
May I say, I forgot, Milton Friedman has a great statement about it. Jeremy Siegel thinking, you know, these are people that are well-known, that, you know, certainly, Jeremy Siegel's on CNBC about 3 times a week. I mean, these are people that investors hear about.
Would you open up to page 84 of your direct testimony, please?
Yes,
Yeah, here's, line 1796 is where you make the point. The second reason you disagree with her is that this quote, long-term EPS and GDP growth rates are directly linked, correct?
yes,
That's your position. And it's also your position that you believe that the growth in the market cannot exceed GDP.
yeah, I mean.
Is that right?
Yes, and the justification, I have a study in my testimony where I track GDP and EPS over the last 50 years, and they're pretty closely related. So that's what and that's why I make that statement.
Understand. Now, if you'll flip the page to page 85 and 80, pages 85 and 86, this is where you walk through your example of that you used to challenge Ms. Bulkley's EPS growth rate, correct?
Yes,
All right, and you use the example of GDP growth, you know, is growth in the U.S. economy, correct?
yes,
Okay. And GDP measures the value of the final goods and services produced in the United States, correct?
yes,
And the growth rate of GDP is therefore limited to the growth in the final goods and services in the U.S., correct?
yes, but a lot of these sales are outside the U.S., so it's not this U.S. economy that's driving this. Obviously, big corporations.
Yeah, we'll get to that here in a
It's
second.
part of the international side of it, yeah.
Yeah. You would agree, would you not, that a closed economy is one that does not engage in trade?
Yes,
And the U.S. is not one of those economies. They engage in trade all over the world.
yes,
Okay, so now Ms. Bulkley provided for her EPS growth rate one of the documents she used, and if you have this, great. If you don't, I'm happy to provide it to you. She had exhibit. Let me find it here. It's her exhibit AEB-7 is where she identifies the and shows the manner in which she arrives at her market risk premium from the S&P 500 index.
I do not have that exhibit.
All right, let me get that for you. May I approach? You may. It's right here, Doctor. I think, yes, that's it, isn't it? Let me ask that again. Is that your understanding of Ms. Bulkley's work paper or exhibit that shows?
Yeah, I'm very familiar with this approach. I think the key thing for the commission to look at is if you look at kind of the right-hand column, column 11, they take the S&P 500 companies and they take analyst growth rates. So you go to IBIS or Bloomberg, one of the services, you download the growth rates, she weights them by their market cap. So they're, you know, obviously Google has a much bigger impact on the market than company XYZ. And so she sums those weighted, cap-weighted growth rates, sums them up, and she gets the overall projected average analyst growth rate for the S&P 500 companies.
Thank you. Now, while you're looking, would you just look at that with me for a moment? And you agree with me, would you not, that the S&P 500 data that she uses includes companies like Amazon, Apple, McDonald's, Caterpillar, Chevron, Coca-Cola, Dell,
Yes.
Google, et cetera?
Yes.
And you agree that all of those companies produce goods outside the United States,
Yes,
in other countries, for other countries?
yes,
And so that would not be limited to goods produced in the United States, right?
that's reflecting the US GDP, yeah.
And the earnings, let's say, on Apple's products produced and sold in other markets, they don't always count towards the US GDP. If Apple has a facility in Japan and it's operating in Japan, it's not reporting that as a US GDP item, correct?
But
Is that correct?
For the most part, no, because most part, but they bring the profits back to the US, and that's where they're taxed. So, I mean, that, in the end, corporate profits are part of GDP.
Well,
So-
let
they-
me make
they're
sure you're,
limited.
oh, go ahead.
I mean, and you may disagree with Warren Buffett and others, but the GDP and earnings or growth are tied together.
Well, I want to make a distinction between profits and goods produced, right? Profits, I understand your point that profits may come back to wherever that entity is ultimately originates, whether it's in the US or otherwise. But for purposes of calculating the GDP, goods produced by these companies in other countries are not reported as US GDP, correct?
Well, to what extent, different companies have different policies, but you're right, if they're produced elsewhere, but they come back as part of the profits to the company. And that's what goes into GDP. GDP includes corporate profits, and they tend to be about 6% of GDP. The point that Warren Buffett makes was about having more lawyers than citizens in New York City is tied to the fact that you can't grow that from 6% to 20% of GDP, and there's a lot of problems with that.
Right, and I'm not suggesting that, and nor am I trying to disagree with him. My point is just simply that the S&P 500 includes, the data Ms. Bulkley relies on, includes companies that produce goods all over the world that are well beyond what is reported in the US GDP data that you use, correct?
But
Is that
again,
correct?
I would say, I don't know the policies of all these companies, so I don't know exactly how they're going to account for that. I would just say that you look at people who studied this, and there's a tie between GDP and earnings per share. I know Ms. Balke doesn't believe it, but I mean, you know, again, you can't outgrow the economy in the long term. Maybe in the short term, certainly.
Well, I'm just trying to get an answer to my question. So are you saying you don't know whether goods produced by these international companies count or don't count towards the US GDP numbers?
I don't know, for different companies, it's going to be different, so I don't know how they account for them.
Okay,
So I
and-
don't know the answer.
And you haven't then addressed it in the work you've done in this
No, I
case?
haven't. And
Okay.
to me, it doesn't matter because it's tied to profits because that's what goes into GDP.
Well, you just made earlier that you agreed with me that your analysis and your disagreement on it with Ms. Bulkley was premised, at least in one part, on your view that growth rate should be directly linked with US GDP.
Well, they can't exceed it over the long term. And the S&P 500, they make up 95% of the stock market. So the rate at which they're growing reflects overall corporate profit growth in the U.S.
Thank you. All right. Let's see here. I just have one. Mr. Moskin's going to bring around one more exhibit. While he's handing that out, or Dr. Woolridge, would you please refer to pages 54 and 55 on your direct testimony?
Excuse me, Mr. Saban, would you give me those pages again?
Yes, 54 and 55 of the direct testimony.
Yes.
So we're going to start on, and I'll get back to the exhibit in a minute. We're going to start on line 1176. Do you see that?
Yes.
Could you read, and we don't need to read this into the record, would you read lines 1176 to 1193 for yourself and let me know when you're ready?
A point of clarification again, I don't see line numbers on my copy.
Not of the exhibit. This is his direct testimony, Robert.
Oh, I'm sorry.
Page 54 of the direct testimony.
Yes.
It's true, is it not, here that you note that despite your disagreement with Ms. Bulkley, you primarily rely on growth rates from the Wall Street analysts. Isn't that right?
Well, I agree, and I've done studies on this, and I discount those because I know that historically they're 200 basis points below the projected growth rates.
And it's true also, isn't it, that the Congressional Budget Office information, which you rely on for your forecast of nominal GDP, it's projecting GDP based only on the production of goods and services in the U.S. Isn't that correct?
That's one of my sources of projections.
Is that-
CBO is one of the four, yeah.
And is my statement correct, that the Congressional Budget Office data is only based on the production of goods and services in the U.S.?
By U.S. companies, yes.
In the U.S.?
Yes.
Okay. All right. I've handed you a new exhibit. Let me represent, this is again, a excerpt from trying to remember what this book is called. Give me 1 second.
Oh, I know, I think I cited.
You cite this, yes, you do.
I cited this article,
Comer is the name of the
yeah,
author, but this is cited in your testimony, isn't that right?
it is cited.
right.
I go through a detailed analysis between pages like 81 and 90, where this issue is brought up, which you read this article, it basically says why, and this was a short period of time, because over a short period of time, you're gonna have growth rates that are much different from economic growth, and I even provide a graph. I show the relationship between GDP growth and EPS growth in a graph on page 89 of my testimony.
Thank you.
Am I right? This article was about, see this, on figure 18, page 89, that big spike in 2000, right around 2000, I think is tied to this article.
Okay.
Late 18 and early 220, yeah.
Thank you. Mr. Chair, I move for the admission of Rocky Mountain Cross Exhibit 3, which is it's the excerpt that he cites to in his testimony. I think you said at page 89 or thereabouts. Is that right?
What's that?
This is
I say, it's on, my summary of this is on pages 90 and 91.
90, 91, excuse me. Yeah, thank you.
And just to note for the record, this is the entire article by Mr. Comer.
Yes.
Any objection? It is received.
All right, we're going to start in the exhibit on page 3 of 5. I've highlighted for you some quotes that I'm going to read, and then I have some questions for you. The first quote is on page 3 of 5, and it states, "Understanding how international growth could impact S&P earnings is easier than quantifying it. This is because not all companies in the S&P 500 offer sales and earnings data for each region they do business in. Analysts have tried to organize data by either assuming all companies which didn't separate international sales had no international sales, or by only using companies which did offer complete international sales data. Both of these methods are imperfect, but it is certain that international sales make up an increasing amount of the total S&P revenue." Do you agree with that?
I agree. I mean, you look at Apple, more than half their sales are outside the U.S., but those are sales they record in the U.S. and determine profits from.
Well, but you, as we noted earlier, you're not sure whether that they count or don't count towards the U.S. GDP.
Well, as this article says, different companies do it different ways.
Okay. Then we're going to turn to the next page, page 4 of 5. These charts certainly show a direct correlation between international growth and earnings growth, but it is tough to tell the exact nature of this growth. So my question to you there is, do you agree with the author's statement that there is a direct correlation between international growth and earnings growth?
Well, everything, when anything grows, the U.S. has been leading the way for some time, but yeah, international, because economies are interrelated. Sales in Japan are tied to sales in the U.S. to UK, that sort of thing. So yeah, but again, Apple counts all those sales, and you look at the sales number for Apple, I forget what it is, that's their global sales.
But to the extent, as we just discussed a moment ago, to the extent the GDP data you're relying on does not incorporate international sales data or growth data from companies like these, that would not be included in the data or the earnings per share growth rate information you've calculated, correct?
Actually, I think this paragraph really highlights that different companies are going to account for things differently. The important thing is, I use the GDP data the U.S. government publishes, so they're going to include everything they think's relevant. The analysis done by, Warren Buffett and others about the relationship between GDP and earnings growth, they're based on what the government publishes as US GDP.
So again, I need you to answer my question. I understand you have things you want to say, but my question was, to the extent your GDP data that you rely on to come up with your earnings per share growth rate conclusions does not include international growth data, that it would not be consistent with what this author is saying. Isn't that right?
No, I disagree. Like I say, Apple sales or for global sales. But I think this article points out that companies may do this differently. They may set up companies outside the U.S. and just bring the profits back. So I mean, this article highlights the problem. You're right. You know, different companies may do it different ways. I haven't looked into that issue.
Last quote at the bottom of page 4 of 5, quote, "International growth is clearly a primary factor driving earnings growth, but it is difficult to analyze the international earnings data." Do you agree with that?
I agree because accounting differences around the world are going to make that tough to look at.
And how is it that in your analysis you have addressed the international growth rates in the work you've done?
I haven't. I have used the data the government publishes. I mean, different companies are going to do it different ways, but in the end, the earnings growth is going to be tied to what we know as GDP growth. And again, you don't have to believe me. You can believe Warren Buffett.
Are you aware of any investors in utilities that are not U.S. companies?
Oh, yeah.
There are. That occurs, doesn't it?
Yeah.
All right. I think I have no further questions. Thank you.
Okay, I'm going to make an exception to my rule here about assuming there's no cross, because Mr. Saban asked questions about other witnesses that have testified on ROE. For example, he asked questions about Mr. Lynn's calculations. So just want to make sure, Ms. Hayes, do you have any questions of this witness? Because it did address your witness.
No questions.
And Mr. Coleman also came up. Any questions?
No question.
Okay. We're going to take a break before we go to the commission, and we'll be back here at 10 minutes to the hour. Just housekeeping matters. The first one was with respect to OCS Hearing Exhibit 1 for Dr. Woolridge. We have stricken from the document that's in the record the sixth line down, that's page 54, line 1172. So that has been stricken from the document. Now, I understand Mr. Moore wants to present something about the exhibit with, is this Miss Bulkley issue, and having reviewed the?
Yes, that's correct.
Please, go ahead.
Mr. Saban has conferred to me and stated that Ms. Bulkley has reviewed the exhibit, and he will have some very short questioning. I was thinking that may take place before the commission's.
Yes. Yes. So have we not admitted the exhibit then?
All I need to confirm is, one question is whether it changed any of his conclusions. If it didn't, then I'm fine, and that's the end of my questioning, and we can admit the exhibit.
Proceed.
So, Dr. Woolridge, you have in your hand the OCS Hearing Exhibit 1, correct?
Yes.
Can you just tell us whether the changes that you have identified in OCS Hearing Exhibit 1, whether that changed any of your conclusions or the recommendations in this, in your testimony?
No. The issue was the data I used to make my conclusion is in the exhibits. What happened was I did this last minute update. I said, oh, I got to update this data, and I didn't get all the data, the changes. It didn't change the numbers that much, but the updated data was the updated data, and these are the couple ones that did get changed in the testimony. But what's in the exhibits is what was used to get the results.
I think I have what I need then. With that, we don't object to this being admitted into the record to show the corrections to Dr. Woolridge's direct testimony.
We'll admit OCS Hearing Exhibit 1 with the strike through of lines 1172. Do you have any questions you want to ask? Any further questions you want to ask?
I don't think so.
Okay, let's turn to Professor Harvey. It will relate well to Professor Woolridge.
And I will apologize in advance to the people who get to listen to the next few minutes, but I honestly think the use of some of the terms in the cross was incorrect, and the part of me that taught econ for 20 years as a part-time job can't resist. Assuming by looking at you that you and I took econ classes about the same time.
Yes, probably did. I was an econ major at UNC Chapel Hill.
And then I saw that you turned away and went to business administration.
Oh, I'm sorry.
All right. So when I took economics the first time around, we talked about GNP, gross national product, which has now been subsumed or replaced by GDP, gross domestic product. Are you familiar with both of those terms?
I'm familiar with the terms. I don't know all the differences because they count things a little differently. I think you're right. GDP's kind of become the norm from GNP.
Okay, yes, that's right. All right, so I'm not going to put you on the spot. I'm just going to tell you the definitions and let you either agree or disagree.
Thank you.
All right, so GDP, what is currently being used, measures the total value of goods and services produced within a country's borders, while GNP measures the total value of goods and services produced by a country's residents. Does that sound correct to you?
Sort of, yes. That's what I presume, because it's a broader measure of GDP.
Well, it's a different.
Yeah.
I mean, there's things that are in one that aren't in the other, and vice versa,
And I don't
right?
know all the differences.
Okay. And then, are you familiar with the concept of gross domestic income?
Yes. I don't know the definition. I used to know all these definitions. I don't know them anymore.
All right. So when we talk about GDP, we add up what's produced. When we talk about GDI, we add up where if you take the selling price of what's produced and you then go back to the various factors of production and taxes and other charges against. You count up all those sources of income and get GDI. Does that sound right?
Yes.
Okay. And at a conceptual level, GDI should actually equal GNP. Does that sound correct from what you remember?
As I could take that subject to check. I don't remember all the details.
Okay, all right. So as you were mentioning your cross, it's difficult when you get down to brass tacks to really talk about what's in GDP because how companies produce things matters, correct?
Yes.
And it's, so something could be finished production in the United States, but components for that production were produced elsewhere.
Certainly, yeah.
And you can also have the opposite case where components are produced in the United States and its final assembly is elsewhere. Okay? And so any given product that a company that's based in the United States may or may not count fully in GDP, right?
Right. I mean, there's different ways. There's 3 different ways to measure GDP. I look at the income approach, where it looks the income that's produced by all the different entities in the economy, including corporations. So that's the income approach. But I forget the other two.
And that's the GDI.
Yeah.
Okay, all right. So when general folks talk about GDP, they typically don't understand the actual complexity of the calculations.
I agree. I mean, they just assume it's the economy.
All right. So then when we think about earnings of companies, your testimony is that there has to be some link between those earnings and GDP.
Yes.
Okay. But because the calculation of GDP is very complicated, you rely on the government's calculation as the foundation for your analysis.
Yeah, I'm not going to create my own.
Okay, all right. I just wanted to make sure I understood what we meant. Okay, now back to, get my right, where's it at? There it is. Okay, I'd like to talk a little bit about the capital structure, so the equity versus debt. What is your understanding of the actual equity debt structure of the company currently, where it's at?
Well, I have that in my testimony. It's in Schedule Exhibit JRW4, where I look at the historic, and it's down to about 42% as of 2024.
Okay. And then their expected actual in the test year period?
Is they have it going up, but it's going up pretty slowly. I mean, obviously suspending dividends doing that kind of is going to build your equity.
Okay. And then your recommendation is higher than what they are predicting their actual, let's see, let me phrase that right. Your recommendation for the capital structure we use in calculating a rate of return has a higher equity amount, equity percentage, than what they are predicting to actually have.
It is, I mean, at this point, but it's within 2 percentage points, I think. But, so, I mean, I looked at it and figured, well, over the next couple of years, they're going to have to grow their equity percentage as they get recovery of some of these items and that sort of thing, and they build their equity. But, you know, because I mean, in the last case, I said 50% is a good capitalization. They're lower than that now, so the question should be, you know, should it result in higher rates in Utah for some of their issues elsewhere and that sort of thing? So I thought being between what they proposed and where I was before and what they proposed and what they actually are today, I thought halfway between, they're gonna build up to that in the next couple of years anyhow.
Okay.
I thought it was fair to the company and to consumers.
All right. In both your testimony and in the cross, you talked about that rates of return in general for utilities seem somewhat high compared to what Wall Street would typically require.
Wall Street, uses strictly CAPM type things, a risk-free rate, beta, market risk. Every investment firm I know does that. If you look at any of the estimates of Wall Street firms that, they don't always publish them, but, they have low expected returns on utilities, primarily because utility stocks have done well, so the prices are high. Price goes up, the expected return goes down.
Okay, that's what I wanted to ask about, was that statement. That to me sounds like a very short-term explanation, that whenever utility stocks rise relatively fast, then that condition was...
Because you're starting from a higher base. The price to get in is higher. Now, the issue is, why are the prices higher? Is that the growth rate's going up? What sort of thing? So is the discount factor going down? What are the components that utility stocks are up 30% this year?
Okay. But some of the evidence that's in the record talks about a long-term trend with respect to utility returns.
Yes.
I'd like to have you talk about that. What are some of the long-term reasons why utility returns may be diverging higher?
Well, I think AI is clearly, at least that's what the investors think, You look at it, utilities have high exposure to potential AI in particular, the demand for energy tied to that. You see those are the best performing utilities today. And I do this long-term study of the projected earnings growth rates for public utilities. It's in my testimony. I've done this study from 1980 till today. Every earnings growth rate for a public utility that's published by IBIS, and I compare those to actual earnings. And only for like the first time in probably 10 or 15 years, this year we're seeing projected earnings growth rates for electric utilities above 6%. So I really think this potential increase in demand for electric service is getting built into investors' expectations for electric utilities.
All right, so that would be long-term going forward, right?
I mean,
Okay.
right? That's what analysts think. Now, they may be wrong, but
Sure.
I haven't seen a 6% projected growth rate for some time. Now we're back at 6%.
Yeah, now I want you to think about looking back instead of forward. Some of the evidence says that over time, rates of return for utilities have been higher and that it seems to be diverging. Are you familiar with that?
I mean, I'm familiar with the studies I cite that show that authorized ROEs seem to be above what the cost of equity capital is, at least above what capital market indicators would suggest it is. And but I'm very aware of those studies.
Okay, yeah, that's what I was worried about. Do you think that's due to commissions being slow to match decreases but quick to match increases?
That's what the studies suggest, yes.
I was asking what you thought.
Well, I believe in studies.
Okay.
I have my PhD. They look at 3,500 rate cases and that sort of thing. It's pretty exhaustive. And I mean, that's been my observation. I've been saying the same thing for years. Obviously authorized ROEs never came down with capital costs. I did that little study associated with COVID just because it was so dramatic. Interest rates dropped by 150 basis points, authorized ROEs dropped by 30. It was so dramatic. But you also see on the other side, now rates have gone up by about 100 basis points each in 2022, 2023. Authorized ROEs didn't go up that much.
All right, that concludes my questions. Thank you.
We'll turn to Commissioner Clark.
Thank you. Good morning, Dr. Woolridge. Let me begin by offering my best wishes to the Nittany Lions in the college football playoff.
Well, we're hoping it's gonna be, we don't, of course, it'd be like having a game here in December 21st. You don't know what you're gonna get.
You participate in proceedings like this one in a number of jurisdictions every year, I think. Is that
I've
correct?
been in about, Miss Bulky and I think we've both been in about 35 states or so, yeah. She's a little more better travel than I am, but I don't know. I've been doing it a longer time.
Okay. And in your experience, is it common or uncommon for commissions to begin, or at least to make some reference to the existing authorized return on equity in their consideration of the evidence that they receive in a given rate proceeding?
Generally, I would say yes. And, as I think I mentioned earlier, in the world of finance, we talk about anchoring, kind of, you get anchored on a number, a previous number, and then everything's just relative to where that anchor was.
And I noticed you used that phrase in your, I think in your summary, and does that concept or that reference point relate at all in your mind to the principle of gradualism as that applies in the rate-making process?
I think gradualism is reflected in that. I mean, the point came up earlier about the 9.65 in 2020. I mentioned, it was one of the highest ROEs around. And when, authorized returns in 30-year treasuries were a historic low, and the commission said in their decision, this is a function of gradualism. So yes, I agree. That's a perfect example of gradualism at work.
And you see that related concept of gradualism employed in other jurisdictions?
I see it in many states. Some states, they try to avoid using it because it's kind of viewed as a crutch for the commission. So they don't want to use that word, but some other states do believe in it, yeah.
Thanks. That concludes my questions.
Dr. Woolridge, I wish that I could extend you good wishes for your football team, but I have two children who have had their education at Ohio State University. And my oldest son is finishing his 12th year at Ohio State. So I feel like I've supported the Buckeyes for a long time. I do have a couple of questions. In your exhibits, you had a chart. It's connected with your proxy group of 24 companies. I have it marked as OCS Cross Exhibit 9, but I think you have it in your exhibits. I can hand you, if it'd be easier for convenience, just to hand you the OCS Cross 9.
If you don't mind,
No problem.
Great, thank you.
That is what we've received as OCS Cross 9. And I just have a couple of questions just to help me understand your electric proxy group. As I understand it, these are United States-based electrical utilities. Is that correct?
Yes.
Okay. And I want to call your attention to the fourth from the right column, common equity ratio.
Yes.
And you have listed the common equity ratios of those 24 companies. As I look at it, you can confirm this, I see only 3 companies that are approaching or above 50% common equity. Is that right? I see one at 49.9, one at 50.1. Is that 50.1? And 50.7, those 3.
Yes.
And the mean of those 24 companies is a common equity ratio of 40.9%. Is that correct? And the median is 39.9%.
Yes.
Right? Same question with respect to the next column on return on equity. The mean of those, I don't think I need to ask that question. Let's go back to the question on, what I really want to ask is about your capital structure analysis. As I understand it, you took what you said in your testimony was 42.2% of actual equity. Then you took the company's hypothetical request of 50-50, and then your analytical process, as I see it, was to average the two, and then you considered it, it was a fairness argument in your mind that to go to the average of those two was fair.
Yes, I would say that's a very fair judgment. I mean, I looked at the numbers, I looked at where their projections, and they're projecting to go up in equity because of things they're taking, the things they put in, processes they put in place. So I just thought it was fair. I think, I mean, obviously, you can look at the average authorized common equity ratio in the U.S. It's about 50% for electric utilities. So, I mean, I try to balance things out a little bit.
Sure.
And that's what I did here.
And I understand it, and I appreciate your objectivity in that. But here's the question I want to ask. With the common equity ratios of those 24 companies, are any of those companies rated below investment grade by S&P in their credit rating or by Moody's?
No, they're actually, if you look at the columns in the middle of the page, I have the S&P and the Moody's credit ratings.
Right, and that's,
none of them are rated below investment grade.
in fact, they're all a couple of steps above being rated as junk bonds,
Yeah, I
right?
mean, there's no triple B minuses. There are several triple Bs. Mostly, electric utilities, the best part is they're almost all rated triple B plus, and that's the most liquid part of the capital markets for electric utilities. So triple B plus on the S&P side, BAA 1 or 2 on the Moody's side. And obviously, these are all holding companies. They have stock that trades in the marketplace. And these are the proxy companies.
Okay, all right. And now the return on equity for those companies, as far as the mean of those 24 proxy companies, is 9.36%.
Yes.
On the median is 9.28%.
Yes.
And what's your recommendation for return on equity?
9.375.
Okay, all right. I have no further questions. I think that you can be excused, Dr. Woolridge. Thank you very much.
Thank you very much.
And I think we've helped you to make your flight.
Well, I may. We'll see. I'm a little tight. I think I'm
Oh,
spending.
oh no, you can get to the Salt Lake Airport, have plenty of time. I've done this more times than I can count. You'll be just fine.
Thank you very much. So I'm excused.
You were
from-
excused.
Thank you very much.
Yes, thank you, Dr. Woolridge. Appreciate it very much. Okay, I think you were going to take next Mr. Vostok, is that correct?
Yes.
Okay.
The Office of Consumer Services calls Bela Vastek to the stand and asks that he be sworn.
Okay, so since my name has been mispronounced hundreds of different ways over the years, I want to try, I don't always get it, but I want to try to pronounce it correct. So say it one more time before I swear you. Vostok, okay, Vostok. Mr. Vostok, would you raise your right arm to the square? Do you solemnly swear that the testimony you're about to give in this matter pending before the Public Service Commission of the State of Utah shall be the truth, the whole truth, and nothing but the truth, so help you God?
I do.
Thank you. You may be seated. Mr. Moore?
Mr. Vostok, could you please state and spell your name for the record?
My name is Bela Vostog, Bela Vastag.
What is your business address and how are you employed?
My address is 160 East, 300 South, Salt Lake City, and I'm an analyst for the Office of Consumer Services.
In your capacity as an analyst, did you prepare and cause to be filed on October 17th, 2024, direct testimony, and did you prepare and cause to be filed on December 4th, 2024, serve rebuttal testimony in this case?
Yes.
Are there any changes or corrections you'd like to make to your testimony at this time?
No.
If I asked you the same questions in your written testimony, would your answers be the same?
Yes.
At this point, I move to admit Mr. Vastag's testimony.
Without objection, it is admitted. Thank you.
Have you prepared a summary of your testimony that you would like to provide at this time?
Yes, I have a brief summary.
Please proceed.
Good morning, Commissioners.
Good morning.
My testimony, both my direct and my rebuttal in this phase of Rocky Mountain Power's, or RMP's, 2024 general rate case have addressed issues related to RMP's wildfire mitigation plans and costs related to RMP's wildfire mitigation balancing account. I believe that the PSC the Commission has clarified that issues and costs related to RMP's 2023 wildfire mitigation plan are to be addressed in Phase 3 of this docket. However, costs in RMP's wildfire mitigation balancing account that are related to RMP's approved 2020 wildfire plan should be addressed in this phase of the proceeding. Accordingly, my summary today only addresses issues related to the costs in the wildfire mitigation balancing account, which going forward I'll just refer to as the WBA. Rocky Mountain Power filed in this proceeding to recover $21,028,285 of previously incurred costs through the WBA. My rebuttal testimony outlined which of those costs should be reviewed by the Utah Public Service Commission in Phase 1. OCS witness Donna Ramos identified in her direct testimony $9,608,057 of incremental O&M expenses included in RMP's deferral calculation that are related to RMP's yet unimproved 2023 wildfire mitigation plan. It is my understanding that the costs deferred by RMP that are applicable to the 2023 plan will be addressed in Phase 3 of this docket. Ms. Ramos also identified $5,681,724 of internal labor costs that are not incremental to labor costs in 2020 base rates and should be removed from the WBA deferral calculation. My direct and rebuttal testimonies also address whether RMP has developed an adequate proposal for showing that costs in the WBA are incremental to costs that are in base rates. I do not believe that RMP has yet developed a system that clearly, that clearly shows that costs for wildfire mitigation efforts that are similar to costs for non-wildfire efforts or for non-wildfire operational areas such as internal labor, vegetation management, and equipment maintenance are incremental to costs that ratepayers are already paying for in base rates. RMP has provided some analysis to try to show that costs in certain categories related to wildfire mitigation efforts have increased, but the analysis doesn't provide sufficient details to compare these costs to those that were set in the 2020 rate case and are already in base rates. Simply coding some costs to identify that they should be collected in the WBA could result in double recovery of costs. It may be possible that an adequate method for ensuring WBA costs are incremental could be developed in Phase 3 of this docket, or may need to be developed through a collaborative effort involving all interested parties in some future docket. And that concludes my statement.
Mr. Vastag is now available for cross and questions from the commission.
We
Mr.
do not,
Saban?
yeah, we do not have any questions of him in this phase, but we reserve our questions for Phase 3.
Sure, those questions will be reserved for Phase 3. Does anybody have any questions besides commissioners? Okay, Commissioner Harvey.
I don't think these are Phase 3 issues. It's mainly just looking at that incremental concept. So your position seems to me to be that we essentially have, in some cases, identical activities that are both in base rates and in the plan. Is that correct?
Yes.
Such as vegetation management, say. All right. You noted that you don't think PacifiCorp has developed a good method for showing that incremental nature. Is that correct?
To date, they haven't shown, I think, a clear analysis to demonstrate that they're not already in base rates.
I guess what I'm wondering is what type of analysis would you be interested in seeing if you had a magic wand?
Well, it would depend on, each component probably as to what kind of information we would see. Ms. Ramos, in her testimony, talks about how labor expenses and base rates have not increased. So, we'd want to see for internal labor expenses, some analysis that either verifies that labor costs, because if labor costs haven't increased, then and are in base rates, ratepayers through their rates have paid for that. So if there's an incremental charge for labor in the WBA, it would seem that some of those costs could be collected twice, and that would be a concern for our office. So, other areas such as vegetation management, I think they probably could show an analysis of how vegetation management is done for non-wildfire areas versus the wildfire plan, and some areas could be very easy maybe to show. For example, I understand they use some sophisticated software for predicting wildfire risk. That would be unique to wildfire efforts, and you could identify that. So it would just depend on, I don't think there's a one global analysis spreadsheet that could just provide the clarity that we're looking for.
Okay. But a lot of the analysis in the office's testimony relates to the labor particularly.
That was one of the few areas that we were able to identify. The costs were not incremental. There hasn't been a wealth of information available to help identify various components.
Okay. So I think in Phase 3, thinking about the questions that follow from those statements, but I think I'll defer most of them to Phase 3, but a general concept that my sense of what you're saying is there would be an initial threshold of whether something is incremental, and then there would be a second, effort to determine if you felt it was prudent. Is that a fair summary of the way you would approach it?
That's fair, right?
All right, thank you. That's all my questions.
Commissioner Clark.
Good morning,
Good morning.
Mr. Vostog. I want to just ask you to elaborate a bit on the table that is at page 7 of your SIR rebuttal. And I want to ask you about two categories of costs that have some similar labels and almost the same amount, and that maybe is what's produced my confusion as I've thought about this matter. But there's the second row of information is about $5.7 million, 5.6 something million, that you describe as internal labor, not incremental, but included in RMP's deferral calculation. And could you, so just put some more words around that for me to distinguish that between, or distinguish between that category and the category of costs described in the final row of information there. 5.7 million of WA costs at issue in phase 1 that I think you would say the company has not demonstrated to be incremental.
Well, let me preface first, these numbers were developed by our revenue requirement witness, Donna Ramos, who's a CPA. So there's a lot of complexities and interreactions between numbers in the balancing account. So it's like a lot of equations. If you change one thing, it changes, has effect. Anyway, so next week she would probably give you a more clear answer. But in the second row, the 5.6 million is internal labor that Ms. Ramos identified that was that Rocky Mountain Power included in the WBA balance. That is labor from the years 2021, 2022, and 2023. And so she was able to identify, based on data requests and information provided by the company, she was able to identify that as internal labor charged. And then in her analysis, she demonstrates that internal labor costs, expenses, and even headcount were lower in those 3 years as compared to what was in the approved base rates from the 2020 rate case or for the 2021 test year. And so since internal labor expenses were lower, it definitely did not go up, she determined that those should be removed from the WBA and not collected again because they've already been collected as part of base rates.
And so can you distinguish that then from the costs in the fourth row?
Well, so you start with the 21 million, you subtract out the 5.61, and then based on the budgets in the 2020 plan, Ms. Ramos identified costs that were included from the 2023 plan that are in the WBA but related to the 2023 plan. So then if you take out and that amount is the 9.6 million.
Oh, I see, okay.
So then you lower that 21 minus 5 minus 6.6. We're saying that leaves approximately 5.7 million to be reviewed for inclusion or recovery in this phase of the docket. It's kind of difficult because of the two phases and we get.
Yeah, I'm just trying to understand the difference between what's the conceptual activities that are quantified in row 2 and row 4. Are they the same, or are they different, or?
The row 4 does not contain any labor costs, internal labor costs,
Okay.
so. I don't know if I explained that enough, or. Again, Ms. Ramos may be able to provide a clear explanation next week when she testifies.
Thank you. I understand now. Thanks.
Mr. Vostog, I just have one question, if you can help me understand, elaborate on your testimony and your rebuttal on, it's really on, the sentence begins on line 104 through 109. I'm particularly, I'll let you take a look at that a second. I'm just trying to understand the argument on, just, if you'll just give me more of an explanation on the shifting of labor costs from a non-wildfire management plan operational area to if costs are allowed to be collected via the WBA and the costs are shifted, how it could result in double recovery. What's the argument on double recovery?
Well, in that section you refer to, I actually used an example from, I believe it's Ms. McCoy's testimony, and she says an employee may be reassigned from, let's see, make sure I get this right. Yeah, it's just a smaller portion from the quote that I provide, starting on line 78, and Ms. McCoy says, say an employee is hired to the company and spends the majority of their time working on items that are traditionally included in that position's responsibility, I think is what she meant, but it says responsibly. But the employee is reassigned to help implement certain incremental wildfire mitigation projects, such as vegetation management. That employee is now required to track those specific hours worked on those efforts. So my point is that you could have, besides efforts in the wildfire mitigation area, historically, obviously, the company has had employees who work on distribution lines, inspecting them. My knowledge isn't very deep on this, but, repairing faulty equipment, that's their job. So, and those employees would be accounted for in base rates already. They would have been for many rate case cycles. So now, as she explains, if there's a wildfire mitigation task one day and that employee now goes and works on that function, and then their work is coded, as I use, to a work order or to an activity that is now assigned the wildfire designation and is tracked. So those costs get tracked in the WBA, yet originally their labor costs were just part of base rates. Just for this example, they got shifted for that time frame, and now that a portion of their costs are being accounted for in a separate mechanism. So, and there's a possibility that we could end up with collecting those expenses twice if the WBA balance is not carefully, reviewed and analyzed for that situation. So.
And so your conclusion is that at the end of the day, about almost $5.7 million of labor costs should not be allowed to be recovered in the WA. And that's correct, right?
Correct.
And so, help me understand how you arrived at that number.
Yeah, again, this was our revenue requirement witness, Ms. Ramos, went through the detail and identified Rocky Mountain Power internal labor costs that were allocated to the WA deferral balance, and removed those amounts because overall labor expense and headcount had not increased for those 3 years, 2021, 22, and 23, that the WBA is accounting for costs. And so there were no incremental employees needed for the entire operation of the company during those times to conduct those wildfire activities, and the labor costs were included in base rates, which ratepayers have already paid for. So whether or not you can tie who did what is not as important as the company has recovered more labor expenses in base rates than they actually spent in those years. So we find that it would be imprudent to allow the $5.7 million be recovered, because the company essentially has already recovered those expenses and base rates.
Okay, all right, thank you, I appreciate that. And then as far as, you're relying upon Ms. Ramos's computational and her own analysis of the Rocky Mountain accounts. You haven't done that yourself, right? You're adopting what she's
Right. She's
represented.
she's the expert in reviewing those types of.
So any more questions on this subject would be more appropriately asked to her.
Yes.
Oh, okay.
Chair Finn, do you mind if I follow up on your questions a minute?
No.
Thank you for that. So I tend to think about the incremental labor side of this, but can you provide an example of the kinds of costs that you're talking about? Again, back to the reference to your table on page 7 of your SIR rebuttal, that you say WBA costs at issue in phase 1 in the 4th row there. Because you told me those are not incremental labor, and let me just preface that by one of my uncertainties is who the analyst was that actually looked and thought about the categories of costs and how they ought to be assigned versus the just crunching the numbers to come to a revenue requirement total. So is Ms. Ramos the witness that actually did the evaluation of whether the costs were appropriately in the recoverable in the WBA, as well as rolling up the total revenue requirement?
Yes. I was, the table is actually confusing, I think, because we had the same problem when I was writing my testimony. I didn't have a table in there originally, and it was hard for everyone to understand how these costs are organized, and so we thought the table would maybe help, but maybe it hasn't.
Well, but I guess if I'm going to seek clarification about it, it should be from Ms. Ramos.
She's the one who dug into the numbers and understands how they're derived. And as I stated earlier, it's not as simple as this table at all. There's some complexities on the timing of costs and how it's monthly accrued, that it's not a clear-cut number necessarily, so.
Okay, thank you. Thanks, Chair Finn.
Thank you for that additional clarification. I believe that concludes your testimony, Mr. Vostog, and appreciate you taking the time today to be with us. We'll excuse you at this point in time. Ms. Hayes, I think we have Mr. Lynn, who is the Western Resource Advocates witness.
We do.
Do we have an estimate of cost for this witness? I'd like to, my question is whether we can do him now and then take lunch after.
I think we think it will be very minimal, actually, at this point.
Okay, let's go forward.
Thank you. Western Resource Advocates calls Albert Lynn.
Mr. Lynn, we can only hope you don't have to go through that entire box of documents.
I hope so.
Will you raise your right arm to the square? Mr. Lynn, is the testimony you're about to give, do you swear the testimony you're about to give in this matter pending before the Public Service Commission of the State of Utah shall be the truth, the whole truth, and nothing but the truth? So help you God.
I do.
Thank you very much. You may be seated. Would it be helpful if we moved all these other binders off? Yeah. You didn't have to perform the labor yourself, but thank you for doing that.
No problem.
Good morning, Mr. Lynn. Will you please state and spell your name for the record?
Yes, Albert Lynn, ALBERT-LIN.
By whom are you employed and in what capacity?
I'm a financial consultant. I'm employed by WRA.
So on whose behalf are you testifying today?
Western Resource Advocates.
Great. Have you testified previously before this commission?
No, I have not.
Given that,
And welcome for the first time.
Thank you.
thank you. Given that, will you please provide a brief overview of your education and previous work experience?
I've worked in financial analysis and capital markets since 1989, directly after graduating from the University of Texas at Austin, with a Bachelor of Science in Finance, a Bachelor of Arts in International Business, and an Honors Business Master's degrees. I work for a regulated utility called General Telephone and Electric, or GTE, now called Verizon. GTE conducted businesses in over 20 different states in the United States, with most of the company's revenue derived from regulated activities approved by the Public Utility Commissions or similar governmental bodies in each state. My roles were in finance and the audit departments, where I analyzed and supported optimal financial outcomes for shareholders within the policies and orders of each respective state's PUC. I mostly worked on financial and accounting activities, which would likely achieve the highest financial returns possible with the least operating risk and variability of outcomes for GTE's equity shareholders. These roles would include satisfying credit rating agencies that may impact the cost of debt for GTE, which would likely also affect how shareholders perceive the equity value. After a series of legislative changes culminating in the Telecommunications Act of 1996, the primary activities for GTE were fully deregulated across the country. And just prior to passing of that act in 1996, I shifted my work to focus on capital markets, where I became an equity research analyst and a portfolio manager for several Wall Street capital markets firms. From 2020 to the present, I have been focused on economic and financial analysis supporting the energy industry. This includes the regulated electricity sector of the United States.
Thank you. Did you file direct testimony and one exhibit on October 17th and rebuttal testimony on November 15th?
Yes, I did.
Do you have any changes or corrections to that testimony?
No, I do not.
If I asked you the same questions today, would your answers be the same?
Yes.
All right, I will now move the admission of Mr. Lynn's pre-filed testimony and exhibit.
Thank you, Ms. Hayes. Is there any objection? It will be admitted. Thank you.
Thank you. Mr. Lynn, do you have a summary of your testimony to present to the commission today?
I do.
Please proceed.
Thank you, Chair Fenn and Commissioners Harvey and Clark, for allowing me to speak to you today. In order to set a proper return on equity, I'm sure the commission has to consider many factors, including the risks and volatility of operations for PacifiCorp, but also the impact on ratepayers. I want to highlight 3 observations, which I hope will help the commission find a reasonable and appropriate ROE. Observation number 1, I ask the commission to recognize the significance of outside financial resources. The investors of utility stocks and bonds come from the same pool of investors who invest in all industries. The same asset managers, bankers, analysts, accounting firms, credit rating agencies, they serve all these publicly traded companies and their subsidiaries. In my direct testimony, I point to well-known entities with a long history of operating in the financial industry and recommend that the commission consider using more data from unbiased sources who are motivated to be correct for themselves and their clients instead of relying on recommendations and ranges from sources motivated towards a specific outcome. New York University Stern School of Business routinely publishes the cost of capital for equity and debt for various industries, including the utility industry. They do this on their website, and in 2024, it shows the regulated utilities have a cost of equity of 6.55%. Earlier this week, and today, earlier this week, company witness Bulkley criticized this study as not a credible representation of investor expectations. However, this NYU Stern analysis is just as credible as witness Bulkley's analysis because really they're using the same formulas to estimate the cost of equity, and I specifically refer to the capital asset pricing model, CAPM. The main difference between the NYU analysis and Ms. Bulkley's is the NYU study uses real-world market data from inputs to create their inputs like beta and risk premium, whereas Ms. Bulkley uses her own DCF results from short-term rates that are much higher than the formula's requirement for a long-term rate, and I address that issue in greater detail in my direct testimony. This commission can decide if witness Bulkley's use of financial formulas has an appropriate source of inputs, but I'm on the side of the academic studies done by American institutions that train and graduate thousands of financial personnel that work in the real world of finance every year. Another academic study I highlighted in my direct testimony, the so-called Warner-Jarvis study, which was published by the University of California's Haas School of Business. It shows the relationship between real market rates and approved ROEs. The study includes all the approved rates for U.S. regulated electric and natural gas utilities since 1980, the U.S. long-term and short-term rates for corporate bonds, the USA's long-term and short-term rates for the U.S. Treasuries, and the rate of inflation. This study shows that approved U.S. rates of return for regulated utilities do not match the downward trend of all these other rates. Now, since there seems to be quite a bit of confusion about this study, I would encourage the commission to read the Warner-Jarvis report themselves with particular focus on the sections using USA data, although it wouldn't hurt to read the entire report. Bottom line, please integrate real-world data outside of the regulatory decision process for additional guidance on how the larger financial market views risks and returns. Financial markets are far larger than the regulated utility segment of the economy. And also keep in mind, the academic institutions I cite are the ones who have trained and continue to train and educate the very people who work in the real-world economy. As the Supreme Court noted in its Hope decision in determining what is just and reasonable, it is the result reached, not the method employed, which is controlling. This alone is reason enough for the Commission to weigh data regarding rates of return compiled by third-party experts or reported by academic institutions. Observation number 2. I hope the Commission sees that access to capital is not the same as price of capital. Witness Koblia and Bulkley argued that a lower approved ROE will cost the company access to capital markets. This line of thinking is a bit of fear-mongering that is well outside the bounds of what is likely to happen to PacifiCorp in the foreseeable future. The data from S&P discussed earlier this week has shown that any concerns about access to debt markets would only begin when the borrowing entity rates a CCC plus with S&P. Since Pacific Core's current entity rating is BBB plus, it would take multiple downward revisions to move out of the investment grade category, and though the company would still be within a very liquid area of the market to borrow funds, the availability for debt remains very high through all single and double B grades. It is true that while the price of capital or the price of credit will be higher at lower credit grades, the ability to borrow remains substantial. It would take a total of 9 consecutive credit rating downgrades for Pacific Core to become a S&P CCC plus rated issuer, and for any potential credit availability issues. The global corporate debt market is considered very large and deep. It represents the largest pool of available capital only after sovereign debt. The United States represents the largest country market by far, with ample funding for all credit ratings. The evidence just doesn't support any dire conclusions about access to capital. When Pacific Core talks about the affordability of debt, the statement should be viewed as representing Pacific Core's point of view. Using the term affordable only makes sense from the perspective of the company and its investors. Obviously, a lower credit rating generally results in higher borrowing costs. If a lower authorized return on equity triggers a downgrade to the credit rating, the customers of Pacific Core would likely see a financial gain, as lower equity rates save more money than the higher interest rate on the company's debt. Regulated, regulated utilities do not need to, scratch that. Let's move to observation number 3. It makes more sense to weigh the data based on the motivation of the source. In simple terms, I hope the Commission places greater credibility on the sources who are motivated to get the ROE right. Everyone in this hearing is biased to seek a certain outcome, whether they admit it or not. I try to rely on the best data possible and have pointed to such sources for finding a reasonable cost of equity and return on equity. The results of the analysis that I point to in my direct testimony are critical data points for the Commission as it considers how to appropriately balance ratepayer and shareholder interests in setting an approved ROE. In my direct testimony, I show that there is a long-standing gap between expected returns on equity as estimated by financial institutions and academic researchers and the ROEs that are actually awarded to regulated utilities. I see the gap between the market-required ROE and awarded ROE slowly closing, but the Commission should ensure that closing the gap continues to take place over a reasonable amount of time. The Commission just heard witness Woolridge explain that Wall Street will use lower numbers than a commission or a regulatory proceeding, but I would just simply ask the question, why is that the case, and shouldn't we pay attention to what Wall Street and the larger market thinks? I've worked with several commissions over the past few years, and the concept of gradualism and moderation of approved returns on equities is a common thread. Now, this is the first time I'm before the Utah Commission, but I hope I've been of some help in providing some analysis and information largely based on common sense and fundamental operations of the financial markets. That concludes my prepared statement.
Thank you, Mr. Lynn. Did you listen earlier this week to the series of questions Commissioner Harvey asked Ms. Bulkley?
I did.
Do you remember when Ms. Bulkley discussed an Illinois Commerce Commission decision that resulted in Ameren's stock price falling?
Yes.
Do you have an opinion or a response to what Ms. Bulkley said?
Well, my first reaction is to wonder whether or not it's the job of the Commission to even worry about the stock price. I hope we all agree that it should not be a high priority. But the real issue is what happens to the utilities' access to capital? It turns out Ameren, Illinois, issued $625 million in bonds at 5.5% interest due in 2054, just 6 months after the ICC's decision.
Mr. Chair, this is all new information that was not anywhere to be seen, and it was not in his rebuttal or anybody else's surrebuttals. This is live, not surrebuttal, but live direct.
Ms. Hayes?
Yes, I thought it was fair to ask Mr. Lin about questions that came up in cross-examination earlier this week. I am asking them right now before I make Mr. Lin available for cross so that if council wants to follow up and ask questions, they may. But I wanted to provide Mr. Lin a response to, or an opportunity to respond to what was said earlier this week.
I don't have a problem with that, except that I don't have any way to assess this because Ms. Bulkley's never addressed this and she's not here. This wasn't in his presentation, nor was it in hers. It was in response to a commission question. So neither, we weren't offering it, it was a response. I don't think I can, on the fly, cross-examine him about something that I just heard 5 seconds ago.
Well, I appreciate that, but it came up in response to a question Commissioner Harvey asked, and I'm going to allow the question to stand. I'm going to overrule the objection. If you want to, we're going to take a lunch break, and we can recall Mr. Lin to the stand if we need to after lunch, if there's any way you think that you need more information.
I think I'll just then ask that we wait to do cross till after lunch so I can go talk to somebody about this. I don't have any idea about it.
I think that's fair. Can we do that? We'll just, let's, what's that?
Yeah.
Is that okay, Ms. Hayes?
Absolutely.
All right, let's adjourn for lunch. It's that time anyway.
I don't think
Are you, well, he was done with this, no, he was done with this summary, wasn't he?
He
was
was
done
done,
with this summary, and you were asking the follow-up questions is all.
yeah.
So it's an appropriate time to break for lunch, don't you agree? She asked the question, I thought.
I have a couple of questions.
Oh, okay. Why don't you ask the questions?
Wonderful.
We'll reserve the answers so that Mr. Saban can hear the questions that are going to be posed, and Mr. Lin can answer those after
All right.
lunch. And if you'll probably have them on your computer, but if not, the court reporter can read them back after lunch.
All right. So the question about what Ms. Bulkley said about Ameren's stock price is the first one. The next question was relating to something Ms. Koblia said about PG&E being a price taker as opposed to a price maker. And then I wanted to follow up on a couple of discussions Mr. Saban had with Dr. Woolridge this morning. And I'm happy to talk about what Mr. Saban was discussing, or I could just give you the question that I'm thinking of asking.
Either way.
All right, well, Mr. Saban was asking Dr. Woolridge about the 2020 rate case and the then current economic conditions. I wanted to pose the question to Mr. Lin, how fast should approved utility returns on equity change, or how quickly they should change to reflect current economic conditions? And then finally, in discussing the NYU Stern analysis, Mr. Saban asked some questions about why Wall Street numbers are not appropriate to use for regulated utilities, and I wanted to follow up on Mr. Lin's opinion about that.
Okay, with respect to those latter questions, my viewpoint is those are things that came up within the scope of cross, and she's entitled to ask questions about that. But we're not going to make a ruling on any of these till you have a chance to analyze the issues that you think are appropriate, and we'll take an hour and 15-minute break for lunch. We'll be back here at 1:50, well, an hour and 12-minute break for lunch. We'll be back here at 1:15.
Thank you.
We'll be in recess. The lunch break, and Ms. Schmidt has something to talk about.
Thank you, Chair. I have let the division witnesses know that there is a chance they may be called on Monday if we get through more than just Trevor and Casey. Right now, we have our 3 outside consultant witnesses, Daymark, as date certain witnesses on Tuesday. I need to add 1 DPU witness as a date certain person on Tuesday because he's unavailable on Monday and is unavailable on Wednesday. His name is Jonathan Lee, and and depending on how Monday goes, he might get bumped up in the order of the DPU witnesses listed for Tuesday. Or we might end up taking some of the
Well,
DPU.
he's listed as the 5th, 6th witness on Tuesday currently.
Yes,
And he can go on Tuesday?
he can go on Tuesday. I was
All
just
right.
letting you know that he can't go Monday and he can't go Wednesday. I just learned that today.
We'll get him on Tuesday.
Perfect. Thank-
So on Tuesday, your job will be to remind me if we get down to the afternoon and we need to move him in front of your other witnesses. We know we have 3 that have to be done already that day, and now we have 4. And I think we're good. While we're talking about that, wait for it, Mr. Dauphiné. And Mr. Jones will do first thing. Are they gonna appear just on, either way is fine, in person or on streaming?
For Mr. Dauphiné, he is with Brubaker and Associates, and so he may be in the same conference room from which Mr. Gorman testified yesterday.
Okay.
I've alerted him to the audio question, and he's gonna be looking into it and looking for ways to improve upon that.
That would be appreciated.
But he will be remote, and we appreciate the accommodation.
Okay. He'll be here.
We also got news at the lunch hour that the streaming stopped sometime in the middle of, either at the end of the prior witness, Mr. Vostog, or somewhere in Mr. Lin. So I'm not sure if there's a way to check it. I just know the streaming was out for a while, so.
Can we tell whether it's working now? It's working now.
Just letting you know.
No, I appreciate that. We don't want that to happen. So. Okay, let's go back to the issue of the objection of the questions that Ms. Hayes was beginning to ask Mr. Lynn. The questions have been posed. Mr. Saban, do you want to, you were going to check on some things. Do you want to make your objections again?
Well, here's my objection. It's not unusual, as we had before, where surrebuttal testimony is submitted and then a witness who's not had an opportunity to respond addresses that. I want to be clear that is not what's going on here. Mr. Lynn, in Ms. Bulkley's testimony, she cited to the ICC orders, she cited to the Avant-Grid issue, she cited to all of these things that he's going to comment on, and he didn't address them in his surrebuttal testimony. So that was my objection, was I thought that that was his opportunity, if he wanted to address those items, make a point about them, to do it then. If the chair is inclined to let him testify about those things, fine, we'll deal with it. We may reserve the right to call Ms. Bulkley as a rebuttal witness virtually and see if we can do it that way. I'll do whatever I can today in the short time we were able to have during lunch, but that's our position.
I appreciate your position. Let me tell you how I'm going to rule on this. I understand that your argument is that Mr. Lynn did not respond to Ms. Bulkley's pre-filed testimony. However, as I remember the question, Ms. Hayes was asking a question that came up when Commissioner Harvey asked Ms. Bulkley a question. She then, at that point, got into the findings with respect to the Illinois Commission. And so I think it was a question that came up in cross, and I think that's what you're driving at. So
My point was just, she addressed those in her testimony, and he chose not to respond. The ICC decisions are in her testimony.
I understand that, but this is a question arising out of it's not cross, it's a commissioner question. I'm gonna overrule the objection, but I am going to allow you, if you want to ask questions about it and you feel like there is a need to recall Ms. Bulkley. I'm assuming she's not local, is that correct?
No, she's from the East Coast.
We would obviously allow that to be done if you need it. And we'll accommodate the schedule on that if you think you need to do that. We'll allow you to, if you feel like you need to further rebuttal, and we'll do that. Okay. Anything else, Mr. Saban?
No, nothing for me.
Okay, Ms. Hayes, we'll let you go back and ask your questions and allow Mr. Lynn to give his answers.
Thank you, Mr. Chair. Before I do that, I was alerted after we broke for lunch that in moving the admission of Mr. Lynn's direct and rebuttal testimony, I said testimony rather than testimonies. And so I just wanted to clarify that I was moving the admission of both direct and rebuttal.
You may want to be one of the most precise lawyers to ever have appeared in this hearing room. Thank you. Your correction is noted, and we will receive the testimonies.
All credit goes to counsel for the Utah Large Customer Group.
I would have expected nothing less of them. Thank you. Okay, continue.
Thank you. I could restate the question, or we could ask the court reporter to go back and review what Albert was saying at the time of the objection.
Why don't we do both? Why don't you read the question back, and then if you need to state your question, we'll do so. And I'm going to take 30 seconds to go get my notepad while she does that, and we're not being recess. I'll just be right back. Oh, I'm sorry. I thought you were going to continue while I was gone. So, no, but you're very polite. Thank you. So, where are we now? You need to read it back now? Okay, thank you.
Okay. So the question was, do you have an opinion or response to what Ms. Bulkley said? And the answer was, well, my first reaction is to wonder whether or not it's the job of the commission to even worry about the stock price. I hope we all agree that should not be a high priority, but the real issue is what happens to the utilities' access to capital. It turns out Ameren, Illinois issued $625 million in bonds at 5.5% interest due in 2054, just 6 months after the ICC's decision, and that's where the interruption happened.
Okay. All right. So it was an incomplete sentence. So let's go back and have you ask the question that will allow him to answer that sentence completely.
All right, Mr. Lynn. Earlier you were talking about how in response to an Illinois Commerce Commission decision, stock price fell, and you said the real issue is the utilities' access to capital. Can you go forward from there?
Yes. So the fact that 6 months after this ICC decision, which was supposed to be so crippling, that 6 months later, Ameren, Illinois, the exact subsidiary of Ameren, the parent company, could go on its own and issue $625 million of debt at, I would say, a pretty reasonable interest rate, is very strong evidence that access to capital was not a problem, which is, I think, the key we're getting at here. Witness Bulkley adds, analysts were upset. They use words like draconian and onerous in her testimony. But the fact of the matter is the stock price that Illinois decision was made almost exactly 1 year ago. It was December 14th of 2023. Both of the stock of both Ameren Illinois and Ameren Parent Company are up. I think as of 2 days ago, it was 10%, 9.9% for Ameren Illinois, and 17 point something percent for Ameren, the parent company. So I just want to make sure everyone has the facts of what happened so that we make the best decision here. I'm not trying to circumvent processes or anything like that, so I hope that helps.
Thank you, Mr. Lin. My next question is related to the conversation I had with Ms. Koblia the other day, wherein she described wanting Pacific Corp to be a price maker, and she was comparing Pacific Corp with PG&E and highlighting them as a price taker. And I'm wondering if you have any conclusions to draw from that discussion about PG&E.
Well, I believe it serves the commission better to not put much weight on emotionally charged words like price taker or price maker. The fact of the matter is the way bonds are placed, especially for multi-million-dollar corporations, is it's a multi-handed bank syndicate, and it is their clients that bid on what they're willing to buy at what price. If there's enough to close the deal, any transaction that is closed automatically means there were price takers. And so I think a more objective way of just thinking about it is, was the capital markets available when a company wants to issue bonds? And it was specifically asked in the hearing about PG&E, and that's when she called them a price taker. But the fact of the matter is PG&E issued $1.75 billion of 30-year bonds about 30 days ago. And they did it at a 5.9% interest rate. Pacific Corp wants 5.21. In my view, that's not a gigantic gap between a investment-grade Pacific Corp and a twice bankrupt, going through their third bankruptcy, junk-rated PG&E. But in either case, capital was available and the deal closed in a single day.
Thank you, Mr. Lin. As I mentioned earlier, I have another couple of questions about Mr. Sabin's discussion with Dr. Woolridge this morning. First off, he discussed the 2020 general rate case and then current economic conditions. And my question related to that is if you have an opinion about how quickly approved utility returns on equity should be changed to reflect current economic conditions.
Well, it's a difficult question to answer in some parts because I think it is up to the purview of the commission. What is the right time to react to a market? I have always taken the view that most commissions want to ensure that their electric utilities are extremely stable and therefore everything is done in a measured and conservative manner. Hence this general idea of gradualism. No knee-jerk reactions because everyone needs to plan things because most of the money spent is on very long life asset type of projects. So when looking at the right timing, I don't know. But we do know from the evidence that I presented from the academic studies and others that the cost of capital for utilities has been lagging a 40-year trend in the general markets. The bond markets, we never really debate because they react right away. So there's no avoiding the fact that the bond markets react pretty quickly. But the equity markets react quickly, but not for regulated electric, natural gas, and for that matter, water utilities. But how much of that lag is correct? I don't know, but I do think we need to continue moving towards the real rate that represents the cost of equity.
Thank you. And then my last question is related to a question that Mr. Sabin asked of Dr. Woolridge related to the NYU Stern analysis about Wall Street having lower numbers than utilities authorized returns on equity. And Mr. Saban's questions, I think, implied that the Wall Street numbers were inappropriate for regulated utilities. And I wanted to get your response.
Well, there was certainly a lot of back and forth this morning about how is it that Wall Street has such a low rate for cost of equity versus what commissions it. Now, Dr. Woolridge talked about anchoring, and he talked about the fact that the stock market and Wall Street has already priced it in with the stock price of the utility. And I would just put it to everyone more simply. You just have a giant world pricing money, and then that is generally for all industries. Then you have a subset of a regulated world where utilities and others are having their cost of equity set by small groups that do not have to necessarily respond to the market. That gap, I think, is problematic. And now when people start to use formulas to try to separate them, like we had a lot of discussion in particular about the GDP and if that's the right number. And I would say let's forget the small examples of companies hiding out with subsidiaries as American corporations building stuff in foreign countries and somehow escaping the GDP measurement model. Why not look at World Bank data, IMF data, or other sources that measure the whole world? And yes, the whole world is growing faster than the US. The average by World Bank and the IMF is about 0.5% higher. But the point Dr. Woolridge is making is still valid. You can't grow faster than the world. So forget the monkeying around of who's doing the right accounting and who's reporting the right thing between the US and international markets. The fact is, last year about 2.7% global growth, about 2.5% US growth, fine. Then let them use the higher number. But it's nowhere near the numbers Witness Bulkley is trying to use.
Those are all of my questions for you, Mr. Lin. So I would make Mr. Lin available for cross-examination at this point.
Thank you, Mr. Lin, Ms. Hayes. We'll turn the time over to Mr. Saban for cross.
Can I have Mr. Moskin hand out an exhibit here? This will be RMP Cross Exhibit 4, and I forgot to put the little box on it, so you'll have to write it in. All right, Mr. Lin, I'm showing you what's been marked as deposition exhibit, Rocky Mountain Power Cross Exhibit number 4. Do you see that?
Yes.
This is a DR response provided by WRA that was directed to you, isn't that right?
Yes.
And the question, I guess I should move to admit, your chair would move to admit Rocky Mountain Power Cross Exhibit number 4.
Without objection? Oh, okay, this RMP Cross 4 is admitted.
All right, the question, Mr. Lin, was referencing Mr. Lin's rebuttal testimony at page 2. Please provide all Mr. Lin's work papers that support his reference to the outcomes of models from financial institutions. Further, please provide the work papers used to develop the charts provided on pages 8 through 25 of Mr. Lin's direct testimony, which appear to summarize models from financial institutions.
Just a second, I think you may have said 8 through 25.
18, excuse me, 18 through 25, thank you. If Mr. Lin does not have work papers to support these charts, please identify the origin of the charts and how Mr. Lin verified the data summarized in the charts. That's the question, right, Mr. Lin?
Yes.
Okay. And the response was that as to the two charts, with respect to the first one, and I'm looking right under the response, WRA responds, they come from the following sources. And so the first bullet there under the response is Mr. Lin's direct testimony citing the Werner and Jarvis rate of return regulation revisited. The answer is that the, quote, the same chart in Mr. Lin's direct testimony can be found on page 13 of the U.S. Berkeley study, correct?
Yes.
So that was not a study or any work that you yourself performed, correct?
Correct.
And did you do anything to verify the accuracy or the methodology used in the chart?
Yes. I mean, I did compare and validate that all the interest rates and inflation did correspond to the Federal Reserve Bank of St. Louis, which publishes and is generally regarded as the origin or source of that information. And I did look up a subset of the actual rates and rates of return that were in the RRA's database.
Okay. The second chart then that is referenced on page 23, citing to the North Carolina Utilities Commission docket, and there's the docket number there. For brevity's sake, the bottom of that bullet says that the same chart in Mr. Lin's direct testimony can be found on page 27 of Mark Ellis's testimony in the North Carolina docket. So again, that's nothing that you prepared, correct?
Correct.
That was prepared by Mr. Ellis?
That's right.
All right. Do you have, there should be binders near you. Let me help you. May I approach? Right. In that binder, you should find Ms. Bulkley's testimony from the company. Would you please locate her surrebuttal testimony there? Did you find that?
I have not yet. Do you know which tab it's on? The other one? What?
I don't think this has the surrebuttal though. This is something. Sorry, I've got it. Excuse me, I gave the exhibits. I'll just. All right, I've given you Ms. Bulkley's surrebuttal testimony. Would you please open up to page 10? And we're going to go to line 182. Do you see that?
Yes.
Line 182, the question is there any precedent of which you are aware where a regulatory jurisdiction has agreed with Mr. Lin's position that authorized ROEs are more than 300 basis points higher than the cost of equity for a regulated utility? And her answer is, starting on line 185, no. In fact, figure 2 of Mr. Lin's direct testimony, the one we were just talking about, summarizes the return estimates from financial institutions that, in his rebuttal testimony, he suggests the commission should rely on in setting an ROE in the range of 6.55% over time. The analysis presented in Mr. Lin's testimony appears to be copied from testimony filed by Mark Ellis in a Duke Energy Progress, or DEP, rate proceeding in North Carolina in 2023. So let me just pause there. Is that correct, that this second bullet point information came from Mr. Ellis's testimony in North Carolina?
Yes.
Okay. Mr. Ellis filed, and we're back on line 190. Mr. Ellis filed these charts in the DEP rate case, suggesting an equity market return over the projected 10-year period of 6.5%. In that proceeding, Mr. Ellis proposed a return on equity for Duke Energy of 6%. The North Carolina Commission authorized Duke Energy an ROE of 9.8% and specifically disregarded Mr. Ellis's analysis and recommendation, stating stating the following. Quote, the Commission concludes that NCJC et al. Witness Ellis's outcome and 6.25% is an outlier and should be ignored. Apart from being more than 300 basis points below any rate of return on equity ever approved by this Commission for DEP, it is scarcely 200 basis points above DEP's embedded cost of debt, a premium that is clearly insufficient to compensate investors for the added risk associated with equity ownership relative to a debt holder's claim on the same enterprise. Did I read that correctly?
You did?
It's true, Mr. Lynn, is it not, that this statement by Ms. Bulkley, her characterization is correct, that the North Carolina Commission rejected Mr. Ellis's attempt to proffer the very same arguments you are making here?
Well, it's not the same, because I certainly did not use Mr. Ellis's 6.25% recommendation. And I would disagree with the idea that it is somehow wrong or incorrect analysis. I mean, his analysis is just copying what those capital market advisors publish to themselves and their clients.
My question was two things. First, my question was, isn't it true that that Mr. Ellis's proposal, which you cite as the second bullet that you're relying on in your testimony, was in fact rejected by the North Carolina Commission as unreasonable?
Yes, it was rejected by the North Carolina.
Okay. And my second question was, didn't we just confirm that you rely on that for your opinions in this case?
Yes, but we're at the Utah Commission.
I understand.
Okay.
Yeah, I understand we're not in North Carolina and that we're here in front of the Utah Commission. Are you aware of any jurisdiction in the United States that has ever adopted the proposal that either Mr. Ellis or that you are making in this, that he made there or that you're making here?
No, I'm not aware of any.
Okay. And when I asked Mr. Woolridge this morning whether he thought that your approach was appropriate, he said no. Do you recall that?
I do.
Okay. And you think he's wrong?
No, I don't think he's wrong.
Okay. Well, if he's not wrong and he's using a different approach, similar to, although not fully in agreement with Ms. Bulkley's, then do you think she's wrong in her approach?
Yes, I do think witness Bulkley is wrong.
You disagree with her number or you disagree with the analysis?
I disagree with both.
Okay. You agree that she used the CAPM model that Mr. Woolridge used. They came up with different, I understand they came up with different numerical conclusions, but they both applied that same model, correct?
That's correct.
And they both in fact, the models they used were the same, right?
I'm going to object. I believe he's misstating the testimony. The input of the models were vastly different. And I don't want the record to indicate that Dr. Woolridge was in agreement with Ms. Buckley when in fact they had diametrically opposed positions. I would agree with Mr. Saban that the mathematical equations are most likely the same, but the endpoints were vastly different, and that's why the numbers were vastly different.
Okay, let me just ask Mr. Saban for clarification. You're saying they both use the capital asset pricing model, but are you also saying that they use the same inputs to that model?
No, I think, I think I said they didn't arrive at the same conclusions. I think at this point, all I've said is they use the same models.
Okay, I'm gonna overrule the objection as to the question that's pending. It's noted where you're going with this, but it's a question just as to whether the models were the same.
Do you agree with me that Ms. Bulkley and Dr. Woolridge used the same models?
For the DCF and the CAPM, yes. I don't know about any others.
Okay, and the approaches that are relied on by you and also by Mr. Ellis do not use those same models in the same manner that either Dr. Woolridge or Ms. Bulkley have used them, right?
Say that again?
The CAP-M analysis that was used in the New York study was not the same, they did not approach the CAP-M analysis in the same way that either Mr. Woolridge or Ms. Bulkley did, isn't that right?
Objection. Approach the model the same way. That's getting into how they work the models, which goes into the inputs, which is the point of difference between Mr. Buckley and Ms. Buckley and Dr. Woolridge. So I think he's misstating the record again.
I will stipulate that they didn't use the same inputs. I'm not asking about the inputs.
Thank you. That'll make it clear.
Mr. Saban, what do you mean by they did not use the models in the same way?
Dr. Woolridge on the stand this morning stated that the way investors the way the Stern School at New York derives its CAP-M numbers was not the same as the CAP-M analysis used in utility regulation proceedings. That's what he said. That's what I'm interested in knowing.
And that's an appropriate question.
Do you agree with that?
That's not what I recall Dr. Woolridge's testimony to be.
Do you believe that the New York Stern study does the same CAP-M analysis that either he or Ms. Bulkley did in this proceeding?
Formulaically, I believe they are using the same formula.
And
input-wise and assumptions, very different.
Okay, and you would agree that the Stern analysis doesn't use the same kinds of inputs that either Dr. Woolridge or Ms. Bulkley used, correct?
That I don't know. I don't know how inputs were derived for Dr. Woolridge. But they are definitely different than witness Bulkley's inputs.
So you just have not studied Dr. Woolridge's inputs for his CAP-M analysis?
I did not.
Okay. All right, so I want to switch topics here for a second. So maybe just one more question on that. If no commissions in the United States have adopted this viewpoint that either Mr. Ellis or you are advocating for, is your conclusion that they are all wrong?
I would say in general, yes, but that's not that they're wrong because they are trying not to set the right rate, but they might be wrong if you need an immediate reaction to market conditions as opposed to practicing gradualism.
I'm not sure I understand. The modeling, for example, that you stated in your opening statement that each of the witnesses on this issue, other than you, have and I can't remember how you put it, they were biased in some way or had some motive one way or the other in what they're offering. Did I say that right?
Roughly.
Roughly.
Everyone's motivated to a certain outcome or a directional outcome.
Okay, and are you suggesting that the WRA is exempt from that? That you are exempt from that?
No, by all means.
Oh,
Definitely
okay.
do not weigh what I say any more than any other witnesses, but weigh much more what the independent financial markets say.
Okay, and there are independent financial market data that both Dr. Woolridge and Ms. Bulkley rely on that comes from analysts, isn't that true?
Yeah, but they're misappropriating the use. Like the DCF was a perfect example. And this whole debate over GDP that we had this morning, that clearly shows that that is an inappropriate use of inputs, as Dr. Woolridge pointed out, and several other witnesses and myself, that is an incorrect way to use the formula that is somewhat unique to witness Bulkley's view.
Do you think there's anything about what Professor Woolridge did in that regard that's inappropriate according to your theory here?
Again, I don't know how he got his input, so I did not study his exact details.
Okay, you were here when he said that he did not take into account international growth rates in what he did, correct?
Yes.
And you just testified a moment ago, if I understood you correctly, that international growth rates are moving higher than domestic growth rates, correct?
Well, I say international growth rates long-term have been slightly higher than domestic.
Okay.
But I concluded that there's no way you can get anywhere close to witness Bulkley's type numbers because the markets just aren't that big.
Okay, but here's what I want to follow up on, though. I take it then, from your suggestion, you agree, I think, by suggesting that we ought to look at IMF data or international data, that we ought to be taking into account those growth rates when we do what we do here. Is that right?
Only to the point if you care about the much smaller international market impact to numbers like GDP. If witnesses like Bulkley are continuing to look for very high numbers that cannot be justified by both the international and domestic market, then I think it's worthy to look into that.
Okay. Lastly, you answered a question about this Ameren stock price issue. Are you aware of any commission decision that has had the impact on a utility of being unable to go out and obtain credit at either to obtain credit or to obtain credit at unreasonable terms?
Well, I don't know about the unreasonable term issue because that's very subjective, but no, I'm not aware of any utility that is regulated and unable to access the capital markets.
Have you studied utility decisions around the country and their impact on the utility's ability to access capital?
Some, yes.
Okay. Are you familiar with the Avant Grid recent decision?
Yes.
Okay. Are you suggesting that they were having the same access to capital that they had before, after the commission decision, that proceeding?
I would not characterize it as the same, but they had easy access to capital. They might not have liked the pricing, but as soon as they raised the price to reflect the proper risk of their lower ROE, they got capital, and it was pretty easy.
What about the APS decision?
I did not look at the APS.
So you don't know anything about that one?
Well, I do know some about it. I do know there was an unfavorable decision and that they sued, but they also subsequently did successfully raise capital. Again, not at the price that they wanted.
After a period, that's true though, after a period of being frozen out of the market, isn't that right?
I wouldn't say frozen out of the market. That was their choice.
Okay. Did you, in your testimony, provide any evidence as to the international growth rates?
Wait, say that again?
Did you, in your testimony, provide any evidence as to the international growth rates, the extent of them, or how they're moving?
International growth rates of what?
The very growth rates we were just talking about. You said that if we're going to take into account international growth rates, which is what we were talking about with respect to Professor Woolridge and Ms. Bulkley, you said those should be taken into account, and you narrowed it to a certain point.
No, that's only in response to Commissioner Harvey's line of questioning about GDP and how to get an accurate number.
I understand, but my question to you was, have you provided any evidence in your testimony as to the international growth rates at all, how they're moving in one way or the other?
No.
And isn't it true that APS, that I was just asking about a moment ago, was only able to access capital after a follow-on rate case?
I did not look into that in that detail.
Okay, no further questions.
Okay, seeing no other cross, we'll go to Ms. Hayes for any redirect.
I have no questions.
Okay, let's go to Commissioner Harvey.
In your professional opinion, does a regulated utility have generally more or less risk, broadly defined, than other large corporations? Thinking about this from the perspective of United States corporations.
In my opinion, a regulated utility has far, far lower risk than an average industry company.
Does the portion of Pacificor that is regulated by the Utah Commission, and I know that's a nebulous concept somewhat, but just recognizing that we have certain things we regulate, Does it sell any electricity or any other regulated product or service internationally?
I'm not aware of it.
Okay. Were you present when, I believe it was counsel for the Utah Large Users Group, but it might have been UAE, presented an example that showed the total cost to ratepayers would decline when credit rating went down, even if the cost of debt went up because of capital structure changes?
Yes, I do recall that.
Did that seem like a reasonable hypothetical to you?
Yes, I would say that there's a strong, very high likelihood that would be the case.
All right, within the, what I would think of as the regulated subset of the much greater credit markets and debt markets that are represented by the regulated utility piece, is there some identifiable risk in terms of access to debt for a utility that was subject to a commission that might be a first mover in trying to get closer to these market rates rather than this subset rate that you talk about?
In my opinion, Wall Street would function like normal, and if the rates went down, the shareholders would not be happy because likely the stock would decline, but customers and users of electricity would be happy from the lower rates.
And just to follow up on that, you're aware that Pacificor is not a publicly traded company, correct?
Yes,
So there is no stock price for Pacificor, correct?
that's correct, but remember, they're a wholly owned subsidiary of several holding companies that eventually are part of one of the largest publicly traded companies with over 2 million shareholders.
Could you proffer an estimate of what percentage of that much larger corporate empire Pacificor represents?
I think it would be easy to look up, but I don't have that off the top of my head, sorry.
Okay. All right. Yeah, I'll leave that. Okay. So, in your opinion, how strong of a tie within this regulated utility space is there between capital structure, meaning the debt equity ratio, and credit ratings? Or is there a tie?
Well, there's definitely a tie, but I believe that as long as the ranges are reasonable, then you should expect the cost of capital to trade within those kind of ranges. So if most utilities are around 50-50 and they have the same credit rating, then I think you should expect their cost for debt would be very similar.
And going back, and I apologize for being out of order here, but to one of the very first questions about how risky utilities generally are, thinking about that tie for companies that you said you consider to be far, far less risky, I think was the term you used. A company that had that type of risk would generally be considered to be able to carry a higher level of debt than what you might think of as an average corporation in the U.S.?
Yes, that's true. And in the NYU Stern study published every year, they actually show every industry's debt to equity ratio. And you will see utilities have a much higher than average debt load, but that's because they're viewed as safer and able to handle and manage and service that debt.
And what type of debt percentages do they typically have in that study?
Most are in the 25 to 40% range.
For?
Debt as a part of their total capital structure.
So they would have 60 to 75% of equity?
By industry, but that's mostly because most of them are in much riskier industries. It is harder to borrow more, right?
You're talking about the regular corporations?
Yes,
I'm
regular
sorry,
corporations. Oh,
I meant to
okay.
ask, what's the, and I may have misstated, but what's the average utility?
Oh, it's about 50.
Okay. All right. And then just in general, are capital markets in the U.S. generally viewed as having plenty of participants, meaning that no individual lender can dictate terms for most standard type transactions?
Yes, I would agree with that.
All right, thank you. That's all my questions.
Commissioner Clark.
I don't have any questions. Thank you, Mr. Lynn.
Mr. Lynn, so I want to make sure I understand your bottom line proposal. Are you saying that you would start with the 9.65% return on equity and pursuant to principles of gradualism, you would reduce it 0.70% to 1% a year to get to what eventually? Is that, first of all, am I accurate in how I stated that?
Yes, I would say that is generally accurate.
And so what do you propose to end up over the course of how many years? What do you propose as consistent with the cost of equity, rate of returns of companies in the market or utilities? What do you propose as the rate that
Well,
should end up?
In my mind, and you will ultimately be the arbiter of weighing all the things you have to do.
Sure,
but
absolutely.
in the short term, meaning next 0 to 3 years, I think it'd be reasonable to say the utility should not have a greater return on equity than the general market. Because I don't think anyone can cogently argue that a utility, especially one of size like Rocky Mountain Power, is a greater risk entity than the general overall market or a company that is viewed as general.
And what do you assert now is the general market cost of equity?
About 8.5%.
Okay.
Maybe you can tick up from that. I'm basing that off the 8.4 something percent that the NYU Stern published in January of 2024.
Okay, thank you. I have no other questions. Mr. Lynn, thank you for your testimony today. You may be excused.
Thank you.
So next on my list is UAE's witness, Mr. Higgins. Is that correct?
That is right, Mr. Chairman.
All right.
Utah Association of Energy Users calls its witness Kevin Higgins.
Mr. Higgins, welcome. Would you raise your right arm? Mr. Higgins, do you solemnly swear that the testimony you're about to give in this matter pending before the Public Service Commission of the State of Utah shall be the truth, the whole truth, and nothing but the truth, so help you God?
Yes, I do.
Thank you very much. You may be seated.
Thank you.
Good afternoon, Mr. Higgins. Could you please state and spell your name for the record?
Sure. My name is Kevin C. Higgins, Kevin, middle initial C, Higgins.
And can you tell us who you work for and in what capacity?
I'm a principal in the consulting firm Energy Strategies.
And on whose behalf do you offer testimony in this proceeding?
I'm here on behalf of the Utah Association of Energy Users, or UAE.
And on behalf of UAE, did you cause to be filed direct, rebuttal, and surrebuttal testimony in this proceeding?
Yes, I did.
And we'll identify it specifically. Did you cause to be filed direct testimony labeled UAE Exhibit RR 1.0 along with associated exhibits RR 1.1 through 1.20?
Yes.
Did you also cause to be filed an errata to that direct testimony?
Yes.
Did you also cause to be filed rebuttal testimony labeled UAE Exhibit RR 2.0?
Yes.
And did you also cause to be filed surrebuttal testimony labeled UAE Exhibit RR 5.0 along with associated exhibits 5.1 through 5.18?
Yes.
Okay, with respect to all of that testimony and perhaps with an exception to the errata, do you have any corrections to make as you sit here today?
Well, I have one clarification / correction that I'd like to make. I'm not going to go through every line, but in my direct testimony and surrebuttal testimony, I refer to an alternative transmission line that was part of Rocky Mountain Power's assessment of Gateway South project, and I inadvertently refer to it as a 235 kV line, when in fact it was a 230 kV line. So I just want to make that note at the beginning that I'm aware of that, that it should have been a 230 kV line reference. With that, I have no other corrections.
And if asked the same questions today that were posed in your pre-filed testimony, would you provide the same answers?
Yes.
And at this point, I'll move for the admission of Mr. Higgins' pre-filed direct, errata, rebuttal, and surrebuttal testimony.
Okay, I just have one question. Mr. Russell, and I can't recall, is the errata, does that correct the difference in the KV lines, or this is an additional correction? Okay.
Yes.
All right. Without objection, we will receive all of that testimony and the corresponding exhibits.
Yeah, just to be clear, the errata made some corrections to Mr. Higgins' direct testimony that were laid out in a red line, and we've filed a new version of the testimony with the corrections made.
I think I recall that now. Thank you.
Okay. And Mr. Higgins, have you prepared a summary of your testimony?
Yes, I have.
Please proceed.
Thank you. Good afternoon, Chairman Fenn, Commissioner Clark, and Commissioner Harvey. I know you've read my testimony already because I've been listening in from my office. So I'm going to move quickly through a number of my recommendations and devote most of my summary to 2 or 3 items that warrant a little more discussion. So I'll start with the annual incentive plan. I recommend that the share of the company's annual incentive plan expense that is related to the company achieving its approved return on equity should be funded by shareholders, not customers. This is consistent with the Commission's long-standing practice, as well as the Commission's 2022 order in the Dominion Energy Utah rate case. Turning to CHOIA number 4, the company's proposal to recover the costs of severance expense and the termination of the safe harbor lease associated with its retired CHOIA Unit 4 plant should be rejected, as these expenditures were not identified as being eligible for deferral and later recovery in the company's previous general rate case. With respect to cost escalation, I recommend, as I do in just about every Pacific Corp Utah rate case, against including inflation escalators in the projected test period that are broadly applied to operations and maintenance expense. While the overall Utah revenue requirement impact of applying inflation escalators in this case is not at all significant, I still believe it is problematic as a general practice to build projected inflation into utility rates before the inflation actually occurs. My concern is not directed to cost projections per se, such as projected plant additions or planned wage increases, but rather to the use of generic cost escalators by activity type. Now I'll turn to the Pension Settlement Adjustments Balancing Account, or PSABA. The PSABA was established following the Commission's approval in the company's last general rate case of a balancing account that would true up the pension settlement adjustments that the company actually recognizes with the amounts it recovers in rates. At this time, there are no pension settlement losses in the test period, nor did the company experience any in 2023. I believe it is no longer useful to retain this single-issue rate-making mechanism. Therefore, I recommend that the PSABA be discontinued. The company does not oppose this recommendation, although the division voiced some objection to it. Turning now to the Washington Climate Commitment Act. Costs associated with the State of Washington's Climate Commitment Act, or CCA, including both the cost of acquiring emission allowances and incremental cost of altering the company's dispatch, should be disallowed from the Utah test period revenue requirement. The CCA should be viewed as a Washington state policy action that should not implicate Utah rates. The 2020 protocol to the multi-state process, which was approved and extended by the Commission and predates the CCA, does not have a provision dealing directly with the CCA. Of the categories of costs identified in the 2020 protocol, the CCA appears to most resemble a state-specific initiative, which, according to Section 3121 of the 2020 protocol, should be situs assigned to the state adopting the initiative. The CCA also has the functional characteristics of a portfolio standard, in that it attempts to influence the utility's resource portfolio by selectively increasing the dispatch costs of resources viewed as less desirable, thereby changing the composition of the portfolio's energy production. According to the 2020 protocol, portfolio standard costs that exceed costs PacifiCorp would have otherwise incurred are also allocated on a situs basis to the state adopting the portfolio standard. The disallowance I am recommending is directed precisely to the costs that exceed the cost PacifiCorp would have otherwise incurred, but for the Washington CCA, and therefore is aligned with the allocation treatment of state portfolio standards in the 2020 protocol. Now I'll turn to the the Fall Creek Hatchery. I recommend that the rate base and operations and maintenance expense associated with the Fall Creek Hatchery be excluded from Utah rates, consistent with the requirements of the 2012 settlement stipulation approved by the Commission in docket number 11-035-200, which precludes the recovery of Klamath Dam removal or removal-related costs from Utah customers. Rocky Mountain Power disputes that this prohibition applies to the Fall Creek Hatchery. The company asserts that because PacifiCorp is obligated to fund interim measures in accordance with the Klamath Hydroelectric Settlement Agreement, or KHSA, the provisions of the 2012 settlement stipulation should not be interpreted as exempting Utah customers from paying for an allocated share of the interim measure costs. My response to that argument is that the 2012 settlement stipulation specifically calls out certain costs that should be recovered from Utah customers, namely depreciation of the Klamath Dam facilities and relicensing and settlement costs, and other costs that could be recovered from Utah customers, which are decommissioning costs, operations and maintenance of the Klamath project for continued generation, and costs incurred in connection with potential future proceedings before the FERC to relicense or decommission and/or remove the Klamath project facilities. The cost of interim measures appears nowhere among these items that are expressly listed as eligible for cost recovery, despite the fact that interim measures is a defined term in the KHSA. If it were the obvious intention of the 2012 settlement stipulation that Utah customers would be expected to pay the Utah allocated share of all interim measures costs, I would expect the agreement to say so. It does not. Now, to the extent that a prudent interim measures cost was incurred to provide continued generation from the Klamath facilities, I would agree that such a cost would be eligible for recovery from Utah customers under the 2012 settlement stipulation, as such an activity is specifically called out as eligible for cost recovery. However, the Fall Creek Hatchery does not fit that description. According to the company's filing in this case, the Fall Creek Hatchery did not go into service until March 2024, after the Klamath project ceased generating power in January 2024. Thus, it could not reasonably be construed to be associated with providing continued generation from the Klamath facilities. Rather, the obligation to construct the fish hatchery should be viewed as a mitigation action intended to minimize adverse downstream impacts as a consequence of the permanent removal of the Iron Gate Dam. Therefore, I believe it is properly considered to be a dam removal related cost that is ineligible for recovery from Utah customers. I'll turn now to other Klamath-related matters, the Klamath Capital Addition. Current Utah rates include the recovery of $3.3 million in Klamath-related depreciation expense and $4.3 million in Klamath-related relicensing and process costs, totaling $7.6 million per year. Under the terms of the 2012 settlement stipulation, these obligations were fully paid off at the end of 2022. Yet they have continued to be recovered in rates throughout 2023 and 2024. In this case, the company is seeking additional cost recovery for Klamath-related capital additions. I struggle to justify increasing the revenue requirement in this case to recover the cost of Klamath-related capital additions that were incurred while customers continued to pay for expired Klamath obligations and rates. The company argues that what I am proposing constitutes retroactive rate making. I disagree. I am not seeking a refund of the 2023 and 2024 dollars that Utah customers have continued to pay in rates for Klamath-related costs, but rather to use a portion of these dollars that remain in rates today as an offset to new Klamath-related costs that the company is seeking to recover in this case. What I am proposing is some balancing of shareholder and ratepayer interests with regard to this issue. Now finally, I'll turn to Gateway South. I am recommending a disallowance of the cost of 32.9% of the Gateway South project, because when the full costs of the project are measured against the economic benefits of the project, it results in a net cost to customers of $415 million using the company's medium gas, medium CO2 price policy scenario. The company's calculation of net benefits from the Gateway South project relies heavily on the assumption that absent the project, the company would have been obligated to construct a $1.4 billion alternative transmission project to meet the service request of a large third-party customer, and that 80% of the cost of this alternative project would have been recoverable from the company's retail ratepayers. According to the company's logic, since Rocky Mountain Power would have been obligated to build the alternative transmission project to serve this single customer anyway, only the incremental costs above the cost of this hypothetical alternative are attributable to the Gateway South project for the purpose of calculating net benefits to retail customers. I maintain that this assumption and the accompanying $843 million credit in the company's net benefit analysis are not credible. If this assumption is eliminated from the analysis, the combined Gateway projects result in the net costs to customers of $415 million that I just noted. My recommended adjustment is to reduce the revenue requirement attributable to the Gateway South transmission project to achieve a break-even result for customers under the medium gas, medium CO2 price policy scenario, with the $843 million credit removed from the analysis. This adjustment is what produces the disallowance of 32.9% that I'm recommending. My fundamental argument is very straightforward. The net benefits from the Gateway South project should be measured using the full cost of the project that will be incurred by retail customers relative to the full benefits they will receive. Instead, the company calculates the net benefits by comparing the full benefits of the project to just a fraction of the costs that retail customers will actually incur. The company's justification for only considering a fraction of the costs is not persuasive. The company counters my argument regarding the $843 million credit by pointing to 12 additional FERC jurisdictional agreements it has entered for generator interconnection service. The company argues that to meet its obligations under these agreements, PacifiCorp would have had to construct the functional equivalent of Gateway South anyway to meet these requests. According to this argument, the avoided transmission costs from building Gateway South are even greater than the $843 million assumed for the single 500 megawatt customer. From a regulatory perspective, I find this line of reasoning to be very unsettling. When the argument becomes, absent Gateway South, we would have to build Gateway South to serve third-party requests, the cost of Gateway South effectively disappears in the company's economic analysis. But of course, the real costs of Gateway South to retail customers have not disappeared. The first-year revenue requirement in Utah is in the neighborhood of $100 million. Expanding the discussion to include the 12 other interconnection service requests does not change the fundamental problem with the company's net benefit analysis, which is that the company never considers the full cost of Gateway South to its retail customers. And unfortunately, when the full cost of the project is considered, it does not result in economic benefits for customers. There may be other benefits that are difficult to quantify, such as improved reliability, that the Commission may wish to take into consideration in this case. But in terms of the economic analysis, the Gateway South cost recovery above what I am recommending does not appear to be justified. And that concludes my summary.
Thank you, Mr. Higgins. I do have questions on two topics before we turn you over for cross-examination and commission questions. During your summary, you indicated that you have been listening to the hearings remotely. Were you able to listen in during the questioning of company witnesses, Mr. Rick Link and Mr. Rick Vale?
Yes.
Do you recall during the discussion with those witnesses some questions coming from, I believe it was Commissioner Clark, related to what happens to the economic analysis when you remove the costs associated with that hypothetical or proxy transmission project?
Yes, I do.
Is that a calculation that you performed in connection with your pre-filed testimony?
Yes, it is.
And can you explain how you performed that calculation and its results?
Certainly. It would probably be easiest to explain if the Commission would look at Mr. Link's exhibit RTL number 1, page 1, and it would be easier for me to explain if that is available to you.
Yeah, only Mr. Clark has it here. The others of us have it in the office. We didn't think we were going to need that today, but
We can share it, can't we?
we'll share. Yeah, we'll share.
We'll look at it.
We'll get
Friendly. So this is Link here.
What's the exhibit number again?
It's RMP exhibit RTL1. It's at the back end of Mr. Link's direct testimony.
Okay.
Got there? Okay, great. So, in Mr. Link's calculations, it's useful to begin looking at the bottom line, which is that under the medium gas, medium CO2 scenario, which is the first one that is presented here. He calculates a net benefit to customers from Gateway South, combined with the D1 segment, of $260 million. So that benefit appears in parentheses at the bottom as 260. It represents $260 million. When you look at the entries here, one of the entries, and I heard this was discussed by Commissioner Clark, I believe with Mr. Vail. When you look at the entries, you can see the $843 million credit for the 230 kV avoided transmission line. So in my analysis, what I did is I reduced the $843 million to zero. And when you do that, it's necessary to recognize a larger OAT credit. So the math isn't just as simple as removing the $843 million. That's the first step. But in the company's analysis, 20% of that $843 million represented a cost share paid by OAT customers. And so it's necessary to add that back in. And so the 20% of the $843 million is $169 million. So what happens then to the math, it's not that complicated after this, is that the OAT credit goes from $129 million to $298 million. You can see that line there. The $843 million becomes zero. And then when you re-add the entries, the $260 million benefit becomes a $415 million cost. So in short, if you take $260 million benefit, you remove $843 million of benefit, and then you add back in the $169 million credit, you wind up at $415 million net cost. So that's how I calculated the first stage of my adjustment. And then what I did...
I'm sorry.
Yes.
There was a cough when you stated the last number the second time, and I didn't hear it.
Certainly.
Would you just the very final number in your...
$415 million. And then to complete the answer to Mr. Russell's question, in your question, Commissioner Clark, what I did in my adjustment is that I compared that $415 million cost, okay, to the gateway, it's called the transmission GWS entry. That's the Gateway South cost, which you can see there is $1.261 billion. And that's the 20-year present value revenue requirement. It's not the full $2 billion, but it's the company's analysis looked at 20 years. So I compared the $415 million net cost to the Gateway South revenue requirement. And I asked myself the question, well, how much does that $1.261 billion have to come down to break even? Well, it's $415 million, right? And so, and $415 million is 32.9% of the present value of the Gateway South revenue requirement. So therefore, I recommend reducing the revenue requirement by 32.9%. So that ties that all together, hopefully, for you.
Thank you. One last topic. During the cross-examination of Mr. Vail, do you recall Mr. Vail being asked questions by Rocky Mountain Power's counsel, drawing a distinction between network facilities and radial lines or radial facilities, and suggesting that this distinction had an impact on FERC's higher of pricing policy?
Yes, I recall that.
Okay, and are you aware of any FERC precedent saying that the higher of pricing policy applies only to radial lines?
No. And in my testimony, I tried as much as I could to simply use FERC's own language in describing the higher of pricing policy. I quote directly from FERC Order 889. I quote directly from FERC's transmission policy. And there's also an additional description that FERC gives that I think sheds light on this issue. That was its own description of its higher of pricing policy that it stated as part of its notice of public rulemaking when it solicited comments that ultimately became FERC Order 890, which is what I quote from. And in the notice of public rulemaking, which was issued May 19th, 2006, and this is from paragraph 284, this is how FERC describes its policy. In order number 888, the Commission stated that system expansions should be priced at the higher of the embedded cost rate, including the expansion costs, or the incremental cost rate, consistent with the transmission pricing policy statement. The Commission has explained that when rolling in the costs of network upgrades incurred to meet a transmission service request would have the effect of raising the average embedded cost rate paid by existing customers, the transmission provider may elect to charge an incremental cost rate for the new service and thereby insulate existing customers from the costs of any necessary system upgrades. However, the transmission provider may not charge both an incremental cost rate and an embedded cost rate associated with existing network transmission facilities. So that's FERC's description of its higher of policy. I don't see anything in that description that limits the policy to radial transmission lines.
Thank you. Mr. Higgins is now available for cross-examination and commission questions.
Is this Mr. Moskin?
Yes, it is. And before I begin, Mr. Chair, I'd like to note, similar to what we had with the WRA, when parties present live sur rebuttal on the stand, with which, of course, I don't have a copy of FERC rulemaking stack here with me to cross-examine on, I guess I just want to reserve the company's right to call rebuttal testimony at the conclusion of the case to address some of these issues.
If you conclude, I think that's a reasonable request.
Okay.
Since you, this is first you've heard about FERC Order 890, and we'll allow you, if you need to call rebuttal witness on that.
Mr. Higgins, it's good to see you again, and good afternoon.
Good afternoon, Mr. Moscone.
You noted at the beginning of your summary that you had listened in, and so you knew that the commission had read your testimony because it had been discussed already at length. And I agree that both in the pre-filed testimony, my client has addressed many of your topics, and in testimony in responding to questions. So for that reason, I actually believe that today my cross-examination will be relatively brief, and I'd like to focus purely on your rebuttal testimony, which is really intended to just make sure I understand the positions you're taking or not taking. Because you concluded with Gateway South, I'll begin there. I want to make sure I just understand your arguments. First, you agree that the company's OAT requires the company to construct system upgrades due to point-to-point transmission service request it received, right?
Yes.
And you agree that the Gateway South and Segment D1 or their functional equivalents had to be constructed to fulfill the company's 12 executed generation interconnection contracts and 1 executed transmission service contract, all of which list either Gateway South or Segment D1 or both as contingent facilities under OAT Section 36. Is that right?
Yes.
So that's a total of 13 FERC jurisdictional agreements, correct?
Correct.
You also don't dispute, I surmise, that the company's load forecast has increased since its last rate case and is forecasted by all accounts to continue to increase.
I haven't challenged the company's load forecast.
You further don't dispute, as I understand it, that the rate that the company is charging the 500 megawatt customer for transmission service is correct. Is that right?
With one qualification is as Mr. Vail, I think, explained, it's not entirely clear yet whether that customer will opt to pay this year or not, but I don't dispute that they're being charged the OAT rate if they wind up moving ahead with their contract at that time.
Okay. Then let's turn just for a minute to this higher of policy that you were just referring to. Setting aside what you believe the company should do in terms of cost recovery for this, or whether it impacts your recommended, what you recommend the commission do you agree with me that the OAT permits a transmission provider to elect the, quote, higher of either the embedded OAT rate or an incremental rate, and the company is not required to directly assign the costs of the alternative line to the 500 megawatt point-to-point customer?
Yes, I agree with that.
In fact, I believe in your rebuttal you said the higher of policy is not a mandate, but is, quote, a matter left to the utility's discretion, close quote.
I said whether it's in that context, I said whether it's a mandate or left to the discretion, and I went on to make another point. But to your question, I am not disputing that it is within the utility's discretion as to how it seeks to recover the costs from the OAT customer.
All right. And is it your understanding that Gateway South was already identified in the company's long-term transmission plan when the 500 megawatt customer came to it?
Yes, and in fact, I discussed that in my rebuttal testimony.
So you wouldn't dispute that the company had already identified network upgrades prior to this request that we're talking about?
Correct.
And you wouldn't dispute, would you, that the company may well be subject to claims it was discriminating against this customer if the company did not use embedded OAT rates with that customer?
Correct, and I would just point out that, Mr. Moscon, you're describing the actual Gateway South contract that this customer has signed. In other words, that they're taking service with Gateway South having, anticipated to be built, as distinct from a hypothetical 230 kV line. But I agree with you that in light of the history, that it would have been potentially problematic to actually try to charge this customer, the 500 megawatt customer, an incremental cost rate, since they were signing up for service or requesting transmission service on a line that was part of the company's plan. So I think that in terms of the actual contract that was signed, I agree that it would have been problematic to try to charge them an incremental rate. My argument, of course, is, I think is about the hypothetical line.
Sure. All right, let's next address the reliability benefits of Gateway South. I heard you in your summary, I don't remember if you used the term reliability, but you talked about other hard to quantify benefits. You concede you did not factor in any specific value of additional reliability benefits when determining your recommended adjustment. Is that correct?
That's correct.
And of course, you read Mr. Vail's testimony in which he explains how a new transmission system was necessary to comply with the company's OAC and FERC obligations, right?
Yes.
And you don't dispute that the Gateway South was identified as the contingent facility solution to the reliability concern, correct?
Correct.
And so you don't dispute that there are reliability benefits associated with Gateway South, do you?
No, I do not dispute that.
And you do not dispute that the commission may take into account the reliability benefits of Gateway South as long-term benefits to Utah customers in making its decision?
Correct, and I did say that in my summary statement.
So now let's turn to Klamath, the Klamath regulatory asset and related transmission. Now, as I understand it, regarding the Klamath regulatory asset, you propose, and I thought I had understood it until I heard your summary, which was slightly different. So let me just clarify. You propose to use the revenue requirement items that were established when setting rates in the 2020 rate case to offset the regulatory asset balance. Is that a fair generalized description?
Yes.
Okay. And although I know you disputed just a moment ago that it was either retroactive or single item rate making, you acknowledged in your rebuttal that in fact that there could be concerns that doing this or going along with your proposal could be considered retroactive rate making, but you thought it was appropriate to balance things out. Is that correct?
My acknowledgement is that I think it could be construed to be single issue rate making.
Okay. All right. You don't dispute that Utah customers got the benefit of power from Klamath facilities until the dams were removed in 2023 to 2024, right?
Correct.
And you don't dispute that the ability to operate these facilities was only possible because the company agreed to build the hatchery as part of the settlement. Isn't that right?
My understanding is that the hatchery was necessary to address the fact that the Iron Gate dam was being removed. It was a necessary mitigation action. It is certainly true that customers were able to receive power from the Klamath Dam until it was completely, shut down. So I'm not disputing that. My perspective, though, is that the fish hatchery was an action that was taken to address the removal of the Iron Gate Dam.
But going back to my question, the Klamath facilities provided a benefit to Utah customers, correct?
Yes.
And if the commission agrees with my client that it was only able to operate those facilities by virtue of an agreement to build the hatchery, you would agree that that hatchery was a necessary part to provide those benefits to Utah customers?
I would agree that the hatchery was a requirement of the KHSA that Pacific Corp entered into. And so it was part of the package that involved both the removal of the dams and the manner in which the dams were operated until the dams were removed.
All right. I'd like to turn your attention now to, I know it's one of your favorite topics, inflation in non-labor O&M expense. Now, you recommend that these be removed because in your testimony you state that they're problematic to project, and I believe I heard in your summary you just say you simply find that they're inappropriate to, before they occur, to include them in rates. Is that correct?
Yes.
You don't dispute that the Commission's 2020 rate case reaffirmed the use of non-labor O&M escalation to estimate these expenses during the test year, do you?
I do not dispute that.
And you would agree, I won't bother taking the time if we were to go back in successive rate cases before that, that the Commission has consistently allowed inflation in the non-labor O&M expense category?
I would say I'm probably 0 for 5, 0 for 6 on that issue in front of the Utah Commission.
All right. Okay, thank you. I don't have any other questions. Thank you, Mr. Higgins.
Thank you.
We'll go back to Mr. Russell for redirect.
I have one topic that I want to address on redirect. Mr. Moskin asked you a question about whether it would have been discriminatory for PacifiCorp to have charged the transmission service customer the incremental cost rate for use of Gateway South, and you had a discussion about whether that would have been problematic under those circumstances. Do you recall that?
Yes.
Okay. Do you have the same reservations or see the same sort of problems in the circumstance where the facilities that were built were the hypothetical proxy 230 kV line that was built just to serve that customer as assumed in Mr. Link's hypothetical analysis?
No.
Okay. Thank you. That's all I have.
Thank you, Mr. Russell. We'll go to Commissioner Harvey for any questions he might have.
Hello. Good afternoon, Commissioner Harvey.
With respect to the annual incentive plan, were you listening yesterday when the company's witness that discussed that was on the stand?
Unfortunately, no.
Okay, all right. There was a discussion that came up that, at least to me, seemed to suggest there were multiple places within what they described as these 6 pillars where financial issues might be implicated. Are you aware of any of those?
Well, I would say that the focus of my adjustment is one in particular, which is related to return on equity.
Okay.
I'll just leave it at that. I said I would leave it at that. That was what I focused on.
Okay, thank you. I'm not asking this to annoy you, but on your inflation escalators, you mentioned you thought you were 0 for 5 or 0 for 6 with the Utah Commission.
Yes.
Have you had success with any other?
Yes, I have successfully made this argument to the Wyoming Commission, and the Wyoming Commission ordered that the company should not use inflation escalators in its rate cases, and they removed them.
Okay. And is your reasoning there related to the incentives that would be present from a regulatory lag perspective if the inflation escalators weren't included, or is there some other basis for your recommendation?
It is related to the incentives related to regulatory lag. I also feel that the inflation escalators really stretch, in my view, the purpose of a future test period. As I'm sure you recall, at one time Utah did not have future test periods, but used historical test periods. Future test periods were adopted, in my view, in large part to address regulatory lag, specifically with respect to the utility's projected plant that it was going to put in service. And so we have made that transition in Utah to future test periods, and as a result have significantly addressed regulatory lag with respect to plant in service. Using inflation escalators as part of operations and maintenance expense that are essentially, escalators that are produced by a company making cost projections that then get applied to the operations and maintenance expense of the company. Seems to me to be pushing the idea of what the purpose of a future test period is a bit too far. That I believe the best indicator of what the reasonable O&M expenses are for the utility going forward, or what it is put into its base period, to the extent that there are adjustments for known and measurable changes, like I indicated in my summary, projected wage increases, for example, or specific items for which the costs are known to be increasing. I do not object to that. I have not attempted to remove those to the extent that they're reasonable. It's the generic escalators that I think are problematic.
All right, thank you. All right, turning to the Washington disallowance issue for the, essentially the energy tax, the allowances have to be purchased. You're very familiar with that, correct?
Yes.
All right. What I want to explore is the idea that we do see on our system certain energy taxes. Certainly Wyoming has a penchant for raising revenue this way, that have been included in the revenue requirements for the other states, at least for Utah. I won't speak for other states. I'm looking for what the general principle in your mind is that would separate a Wyoming, say, wind energy tax from these allowances that have to be purchased to run the generator.
Certainly. I mean, one area that differentiates the Wyoming wind energy tax from the Washington CCA is that Wyoming customers are subject to the Wyoming wind tax. Washington customers are not subject to paying the costs of the allowances that are necessary under the Washington CCA. So that's a very, very big distinction that I think very much differentiates the Washington CCA, say, from a Wyoming wind tax. But I would also, suggest that the Washington CCA does also appear to have the characteristics of a resource portfolio, because it is intended to influence how the company's resources get dispatched and used. And the principles that have been used in the multi-state process, the 2020 protocol, is that states that cause extra costs that are a result of implementing a state policy are the states that should bear those costs. So what I'm saying is that even if Washington customers were subject to the CCA or the costs of the CCA, that there would still probably be an element that differentiates the Washington CCA from, say, a Wyoming wind tax, because the Washington CCA appears to be intended to alter the portfolio the company is utilizing and has some of the characteristics then of certain state policies that are assigned, the costs of which are assigned to those states.
All right, thank you. With respect to the fish hatchery, the Fall Creek fish hatchery that has been mentioned, in your mind, is this, can the disputes broadly be categorized as contract interpretation in terms of what the particular paragraph that your counsel covered the other day with another witness means?
Yes.
Okay. I've got some questions about the gateway that I wish I would have asked a couple of days ago. But just in general, do you have an estimate of what level of revenue the 13 service requests that have been mentioned would likely generate over time?
I haven't made that calculation.
Okay, thank you. I think that's all I have. Thank you.
Commissioner Clark, do you have any questions?
Yes, thank you. I have a few questions. I'd like to start with the FERC's hire of policy.
Yes.
And the utility discretion that you described, or that FERC describes. can you provide a sense of the bases on which the utility would reasonably exercise that discretion to either charge the actual costs of the facility or the rate that would reflect those costs and the embedded costs?
I think that a good example of when a higher of option would be appropriate is in the company's hypothetical. Now, in fact, the hypothetical line was never built. It's only important because it plays a role in the company's economic analysis. But under the hypothetical scenario, we have one customer, a 500 megawatt customer, that is not going to be serving Utah load, that makes a transmission service request. And in that hypothetical, this request is construed as making the construction of a 230 kilovolt line necessary. In that hypothetical, I believe that that would be a perfect candidate for using the higher of pricing, because it would have cost in this hypothetical $1.4 billion to construct. And I believe that if that circumstance had really come to pass, a customer making such a request would likely not sign up to pay for the $1.4 billion cost, which sort of invalidates the use of that assumption that it would be borne by Utah customers or Pacific Corp retail customers, or B, they would be required to pay that because otherwise the utility would have to come to its state regulators and defend why it was asking its retail customers to bear the cost of such a line. So it just seemed to me to be highly improbable or not credible to assume that a line like that would not be subject to higher of pricing. It also, I think, if you indulge me, I believe there's also an expansion on this very idea as well that hasn't really been discussed in the cross of Mr. Vail. And that is that in addition to simply doing higher of pricing or embedded cost pricing, in a situation in which customers, third-party OAT customers, are causing the utility to build new transmission infrastructure, of the sort that Mr. Moscone asked me about, which is, do I agree that the company would be obligated to build? And I agree, they would be obligated to build. An option under the company's tariff, OAT tariff, is to require the customers who are making that request to finance, to fund that line. So if we think about the 12 OAT customers, for example, that the company points out in its rebuttal of me, if indeed those customers were the cause of the company having to build a line that wasn't otherwise in the company's plan, if they were causing the company to have to build a line, the company would be in its rights to say to them, okay, you pay for it, let's say $2 billion. That's about what Gateway costs, right? You pay for it. And the way the FERC tariff works in that sense is that if the customers who cause it fund it, then it doesn't go into rate base, at least not right away. What happens would be those customers would fund it. When it got built, they would be charged the OAT rate. They would not be charged the incremental rate if they funded it. But they would get paid back. The customers who requested this would be paid back over time by getting a discount, or in fact, it would be applied against their transmission service charge. So in essence, under the hypothetical where we've got 12 OAT customers causing a line to be built that was not in the company's plan, they could be asked to pay for it, fund it. In return, they would get a credit against their transmission bill until they were reimbursed for having paid for the line. But in the meantime, that $2 billion is not in rate base. And retail customers are not asked to pay for it until, over time, that transmission credit is paid back to in this case, the 12 customers. And so you have both the higher of policy that could be applied in the case of the single customer, this 500 megawatt customer, right, where I think it's pretty cut and dried that higher of could be applied. Or you have the other process where the customers, the OAT customers who are causing the line to be built, pay for it up front and then get paid back over time or as they take transmission service. In both cases, retail customers do not fund the line. And that is why I believe that the economic analysis is flawed, because it assumes that retail customers would in fact have to pay for these alternatives.
And I think you testified that the pre-existence of the plan for the Southgate or Gateway South transmission line since 2007 or so made the higher of option, or at least the customer pay option, problematic from a discrimination perspective. Is that right? Or I'd like you to elaborate on that.
Sure. I think that what I've looked at in my testimony, and I tried to address this in my rebuttal testimony, because Mr. Link said, well, a problem with Mr. Higgins' analysis of prudence is that he focuses on 2019, right? And my response is, well, I looked really at both 2019 and 2022. But the question you're asking me is really about, I think, the 2019 situation, which is to say that we have the Gateway South project as a project, a plan that is identified as a company planned project. Once that has been identified as a company planned project, customers in the real world, not in the hypothetical world, but in the real world, the customers who want to sign up for it are in essence responding to the opportunity to take service on a planned project. At that point, I believe it's inappropriate for the company's net benefit analysis to assume that much of the cost of Gateway can be assumed away in the analysis, because this customer who now is seeking service after we've announced it as a plan would have caused us to have to build it. And had they caused us to build it, retail customers would have had to pay for it. So I do believe that the fact that Gateway South was a planned project that the 500 megawatt customer and the 12 additional customers responded to voids the company's assumption that it would have had to have built the project in response to these customers, and therefore only the incremental cost above having built the project for these customers should be considered in the economic analysis.
Now I want you to assume a world in which the full costs of Gateway South, at least the Utah allocated rate base associated with that project, is in the revenue requirement, the retail revenue requirement. What would the retail customers' proper expectation be with respect to the 13 customers that have been identified for transmission services on that line, and the rates that they would pay for that service?
Commissioner Clark, are you asking me about what has actually happened in the, let's just say, the real
Well,
world as
I'm
opposed
saying
to the hypothetical?
What should the customers expect, or what should happen?
Well, I believe what should happen is that the 12 customers and the 500 megawatt customer, at this point going forward, should pay the OAT rate. I believe that retail customers should pay for the Gateway South revenue requirement minus 32.9%. And I believe that if the commission wishes to attribute certain reliability benefits to Gateway South, that would make my recommended disallowance smaller, that is within the commission's discretion and would be something you may wish to consider.
And what happens to the rates that the 500 megawatt customer and the other 12 interconnection customers pay?
Their rates are determined in accordance with the formula rate that PacifiCorp has at the FERC.
And how are those revenues treated?
Those revenues, those revenues for Utah rate making are treated as a revenue credit in the revenue requirement. And so as part of the presentation of the revenue requirement, one of the line items is transmission revenue, sometimes called wheeling revenues. And those revenues offset, they reduce the Utah revenue requirement, dollar for dollar.
Do you know whether any of those revenues have been presented by the company in the case?
I would say that my understanding of of the revenues that have been presented is that they represent the company's expectation of the transmission service it will be providing in 2025 to OAT customers. I heard in the testimony I listened to that the 500 megawatt customer is not included in that expectation. I do not know the specifics as to whether the other 12 customers are yet included, but I certainly would expect that as soon as they are taking service, they will be included in the OAT revenue requirement. And then therefore credited against the Utah rates. And I'll also point out that the transmission revenues do flow through the energy balancing account. So even if they're not picked up in the general rate case, they will flow through the energy balancing account.
Just one final question regarding, I think you referred to this in both your direct and SIR rebuttal, but I'm going to use the direct testimony at line 445 to about 448, where you address, and you just alluded to this, the possibility that the commission would want to somehow recognize the reliability benefits of the line. And you say we may want to consider a multi-year phase-in, and I was hoping you could elaborate on what that would look like in your view.
Well, this is one where I really do punt to you on it. And what I'm leaving you with is, in my view, what the revenue requirement should be if the cost recovery is based squarely on the economic analysis. The reliability benefits are more difficult to quantify. So I believe that the commission could consider a range of alternatives with respect to recognizing other benefits. It could be, a reduction in the disallowance that I'm recommending based on your judgment. It to be addressed in a later rate case or the commission could even consider a series of steps by which the benefits are further recognized in rates over time. I think there's a range of things that you could consider, and I simply wanted in this part of my testimony to acknowledge that.
Thank you, Mr. Higgins.
Thank you.
Mr. Higgins, I think I need to apologize if I caused you any distraction while I was perusing through your direct rebuttal and surrebuttal testimony in my notes to see if there are anything that I still wanted to ask after this discussion. And I have no further questions. Thank you so much for being here with us today in your testimony, and you can be excused.
Thank you, Chairman Fenn.
All right, let's just, before we take a break, I have Ms. Kelly as the next witness, but my understand that a lot of her testimony is connected with Phase 3. Is that correct?
No.
Am I missing the wrong person? If I have the wrong person, what is?
Ms. Kelly's testimony is about the energy
EBA.
balancing account and net
Yeah,
power costs.
okay. Okay, that's right. Okay, let's take a break. I've already told Mr. Mitchell we will not have him go until Monday. We'll have Ms. Kelly and your other witness.
And Mr. Boothman did testify about the insurance cost adjustment.
That's what I was thinking about. And is he also talking about ELI?
No.
Okay, I messed up. I'm sorry.
I mean, let me confirm, but I don't think he's planning to talk about excess liability insurance.
Well, yeah, there was quite a discussion about insurance in his testimony.
He did. I think it's quite messy, actually, to
Well,
parse.
okay, good, because that's what I thought too, and then I was starting to feel like I had messed up.
No, you didn't mess up. It's
But he does talk about the ICA, but I thought some of that would be covered in Phase 3, some of his testimony.
Yes, I think he's certainly willing to discuss the issues in Phase 3. His summary today, our understanding was that the insurance cost adjustment proposal itself was part of Phase 1.
Yeah, that's right.
And so, because the issues in his testimony are somewhat hard to separate, I think he quite likely will be addressing insurance-related topics, but he's happy to come back in Phase 3.
Let's cover the ICA, and then any other insurance-related issues, we can cover that in Phase 3.
Okay.
And then I apologize, I'd confused Ms. Kelly. Ms. Kelly is just pretty much just about the EBA.
Yes.
Okay. Let's take a 10-minute break till 25 after the hour. turn to Ms. Hayes and make an introduction before we.
Thank you, Mr. Chair. Western Resource Advocates would like to call Nancy Kelly to the stand.
Ms. Kelly, welcome. Would you raise your right arm to the square? Do you solemnly swear the testimony you're about to give in this matter pending before the Public Service Commission of the State of Utah shall be the truth, the whole truth, and nothing but the truth, so help you God? Thank you. You may be seated. Ms. Hayes, you may proceed.
Thank you. Ms. Kelly, will you please state and spell your name for the record?
Nancy L. Kelly, Nancy Kelly.
By whom are you employed and in what capacity?
I am employed by Western Resource Advocates, WRA, in its clean energy program as a senior policy advisor. I provide policy analysis and regulatory support to WRA in electric industry-related matters, including integrated resource planning and regional transmission-related initiatives. I have worked in the energy industry for more than 25 years, and I have participated in utility regulatory dockets in Utah, Colorado, Nevada, and New Mexico.
Have you testified previously for this commission?
Yes, I have.
Did you file direct testimony on October 17th along with exhibits NK1 through NK5?
Yes, I did.
Do you have any changes or corrections to your direct testimony?
Yes. I withdrew my exhibit NK5 as part of my surrebuttal testimony, and that has created some changes in my direct testimony, plus I had one other correction. So if we turn to page 31 at line 575, the number 2023 should be 2003. It was the 2003 IRP. And then turning to page 42 at lines 754 to 756, strike that second sentence that begins at 753 and goes through 756. And then turning to pages 43 and 44, strike 768 to 803, which removes pages 43 and 44.
And those struck pages are explained, or rather the rationale for striking those pages is explained in your surrebuttal testimony, is that right?
Yes, it is.
All right. Wonderful. Did you file rebuttal testimony on November 15th and errata rebuttal testimony on November 19th?
Yes, I did.
Do you have changes or corrections to that testimony?
I provided corrections to this testimony in my surrebuttal testimony, and it's provided as Exhibit WRA 7.
Thank you. Did you file surrebuttal testimony on December 4th along with Exhibit NK2 corrected and NK6 through NK11?
Yes, I did.
Do you have any corrections or changes to your surrebuttal filing?
No, I don't.
Thank you. So notwithstanding your corrections, if I asked you the same questions today, would your answers be the same?
Yes, they would.
I will now move the admission of the pre-filed testimonies of Nancy Kelly as well as her exhibits, although I would like to ask the commission, given that Ms. Kelly withdrew WRA NK5, I'm happy to strike that from the exhibits that I'm requesting are admitted.
Okay, without objection, we'll accept the direct rebuttal, errata, surrebuttal, the exhibits with the exception of NK5, which will be stricken.
Thank you.
Thank you.
Ms. Kelly, do you have a summary of your testimony to present to the commission today?
Yes, I do.
Please proceed.
Good afternoon, Commissioners. It's a pleasure to be here this afternoon. Oh, sorry. Sometimes I project too far. My primary purpose has been to provide WRA's perspective and evaluation of the influence of the Energy Balancing Account, EBA, on burgeoning net power cost, with a recommendation that you open a new docket to evaluate how to better align shareholder and customer interests. My secondary purpose has been to support Pacificor's request for cost recovery of its new transmission and wind assets. Pacificor's increased reliance on short-term market transactions to meet load obligations is a significant driver in the large increase in net power cost, and Pacificor's acquisition of these assets helps offset some of the increasing risk and cost consequences of increasing market reliance. In my direct testimony, I established the link between management incentives, long-run planning, and resource acquisition, and the incurrence of actual net power cost. I argue that while management may not be able to control movements in the fuel and purchase power markets, it can control its exposure to these markets. In my direct testimony, I did the following. I explained at length how the method of cost recovery necessarily alters the company's view of risk to its shareholders and can result in increased market purchases even as market risk is growing. I pointed to the cancellation of the 2022 all-source RFP as a decision that appears to prioritize shareholders' interests in maintaining credit ratings over customers' interests in reducing future actual net power cost. And I asked the question, how would the company have balanced competing priorities absent the EBA? In its long-run planning activities, I showed that Pacificor has assumed an unprecedented availability of short-term market instruments, termed front office transactions in the near term, in its two most recent integrated resource plans. And I observed that the effect of this unprecedented level of front office transactions in the 2023 IRP update is to delay resource need. And as an aside, I would underscore that the availability of these transactions is a model assumption, not an outcome of an optimization, as was suggested in testimony presented to the Commission earlier in the hearing. I examined Pacificor's net power cost filing in this case, and I compared it to Pacificor's initial net power cost filing in the 2020 GRC, general rate case. I showed that relative to the 2020 general rate case net power cost filing, Pacificor's reliance on short-run market purchases to meet load obligations had increased significantly, even as costs and risks have soared. Specifically, I showed that between the two GRC net power cost filings, despite their soaring costs, the selection of shorter-term products to meet load obligations has grown from 5.6% of total requirements to 13.7% of total requirements. With regard to Pacificor's request to recover the costs of its new wind and transmission assets, I agree with the company that the acquisition of new wind and transmission assets would reduce market reliance and therefore would reduce the incurrence of actual net power cost over what it otherwise would be. And I supported Pacificor's decisions to build new transmission and acquire new wind resources. My purpose in filing rebuttal testimony was to underscore the importance of long-run planning and resource acquisition to the incurrence of actual net power cost. My rebuttal testimony, corrected in my surrebuttal testimony, quantifies the effect on projected net power cost of increased market reliance on these shorter-term instruments between the two rate cases. I separated the effects of the large increase in market prices from the increase in the projected volumes of shorter-term transactions to meet load obligations, and I quantified each of these effects. I showed that almost 40% of the increase was due to an increase in the projected volumes of these shorter-term transactions to meet load obligations. In my surrebuttal testimony, I responded to 3 of the 4 company witnesses that address my direct testimony. I fully rebutted Mr. Mitchell's assertions that my direct testimony is not grounded in any reality, is meaningless, and that therefore my conclusions and recommendations should be ignored. I explained that I had emulated Mr. Mitchell's methodology provided at lines 110 and 111 of his direct testimony, but I had drilled deeper into the results. I fully rebutted Mr. Link's assertion, repeated in a summary, that the cancellation of the 2022 all-source RFP resulted from unprecedented events in the planning environment that alleviated the need for the resources sought by the 2022 all-source RFP. I demonstrated that relative to the 2021 IRP, the IRP which was the basis for the 2022 solicitation, the resource need has not gone away. I concluded that, in the words of Mr. Link, it was downright reckless to not procure the additional resources sought by the 2022 all-source RFP, that if acquired, would reduce future actual net power costs for customers. I further addressed Mr. Link's attestations regarding the lack of influence of the EBA on company decision-making. I agreed that planning analyses are conducted from the customer perspective, their present value revenue requirement analyses. And I agreed that the EBA would not influence the decision to procure a, quote, specific, unquote, resource. With regard to his attestation that management does not consider the EBA when considering market reliance, I'm not surprised. The company expects to recover 100% of its fuel and purchase power costs through the EBA. So the question is not whether management discusses how the EBA would protect it from the cost consequences of delayed resource acquisition, but how it would balance risks if shareholders shared in the cost consequences of delayed resource acquisition that necessarily increases market reliance. With the EBA in place, PacifiCorp shareholders are protected from these consequences, since these costs are fully borne by customers. I believe the question of how the company would weigh the risk of wildfire litigation against the risk of increased market reliance, if shareholders shared in the cost consequences of resource delay, is an unknown because the company executives have not had to grapple with this reality. Finally, I rebutted Ms. Stewart's implied claim that the public interest benefit of the EBA is a settled matter, so there is no need to open a new docket. In support, she had provided quotes from 2 commission orders in docket number 09-035-15. I provided context for her selected quotes, and I provided a number of additional quotes from the March 2011 order that authorized the EBA. The order had emphasized the importance of a sharing mechanism to the Commission's determination that the EBA it authorized was in the public interest. Significantly, the Commission had found it important to maintain meaningful financial incentives to minimize net power cost in both the short run and long run, regardless of the extent of net power cost volatility, and it had found a sharing mechanism to be the best method of ensuring that customer
and shareholder interests are aligned and the public interest is maintained. In light of exploding net power costs, the growth in market reliance is a driver of the overall increase, and recognition that the corresponding cost consequences of this increased market reliance are borne solely by ratepayers, I recommend that the Commission open a new docket to consider how shareholder and customer interests can be better aligned, including the possibility of eliminating the EBA. However, it is my hope that a way may be found to reinstate an EBA with a cost-sharing mechanism similar to the 70-30 sharing mechanism that was originally authorized after the 2-year proceeding in which I participated on behalf of WRA. In a footnote to my surrebuttal testimony, I noted that Utah statute ties 100% cost recovery to an electrical corporation with an energy balancing account established before January 1st, 2016. I have wondered if the reference to 2016 could provide an opening to reassess EBA design given the current political climate. I am not an attorney, so I recommend that the Commission evaluate whether a new EBA with a new design established after 2016 would be subject to the same 100% cost recovery requirement. I believe that an EBA with a sharing mechanism is needed to incent the company to appropriately balance customers' and shareholders' interests in a manner that is currently missing. This concludes my summary.
Ms. Kelly is available for cross-examination and questions from the Commission.
Okay, this looks like Mr. Moskin.
Yes. Thank you, Mr. Chair. Good afternoon, Ms. Kelly.
Good afternoon.
In the summary that you've offered and in your written testimony, you note that in analyzing Pacific Corp's overall rate increase, $265.9 million of that is for capital investments in new transmission and new and repowered wind, correct?
Yes.
And on behalf of the Western Resource Advocates, you are in agreement with at least that part of Pacific Corp's requested rate increase, correct?
Yes.
And specifically, in your testimony, you urge the Commission to approve the company's request for recovery pertaining to Rock Creek 1 and 2 and the Gateway South and Gateway West Segment 1D, correct?
I believe if I looked at my direct testimony, it says approve the decision.
Okay. And did I understand you from your summary to state that at least one of the reasons that the WRA supports that is because those projects would help contain NPC?
Yes.
All right, let's switch to your thoughts on the EBA. In your direct testimony, you walk through a lot of the history of the EBA, right?
Yes.
You note that a form of the EBA was introduced back in 1979, is that correct?
Yes.
You note that it was briefly suspended following a merger because there was surplus generation, is that correct?
No. What I show is that let me turn to my direct testimony so I can have the facts correct.
It's at page 7 to 8, lines 132 to 135, if that helps.
That's not the part I'm looking for. What I'm looking for is at 243 to 253, where I summarize Pacificor's balancing account history in Utah. And I say that Utah Power and Light had a balancing account for roughly 21 years from 1979 to 1990, that the merged company was without a balancing account in Utah for the next 21 years, 1990 to 2011. And then I go through the different variations of whether it was a pilot and whether it had a sharing mechanism.
Right, I don't dispute that, and I think that that's what I was indicating, is that following that merger in 1990, that the EBA was suspended. And
Yes, I agree with that. I
Yes.
thought you said a short time.
Okay.
That's what I was
Okay.
responding to.
Well, in fact, going on, my next question that I think you've alluded to here was that in its current iteration, that the IBA, or the, excuse me, the EBA came back in 2011, though it's been changed, but the EBA as it exists now has in some form been around since 2011, is that correct?
Yes, that's when the current EBA was authorized.
So you would agree with me that the EBA has been an important and large part of the company's cost recovery mechanism for nearly the last decade and a half, is that right?
I agree that it has been important to the company and its shareholders, but I would also note at lines 248 to 253, the variations that it went through. From October of 2011 to June 1st of 2016, the reestablished EBA functioned as a pilot and included a 70-30 sharing mechanism. The legislation was passed in 2016 that removed the sharing mechanism, and the pilot was extended. And so the current EBA, without a sharing mechanism and with non-pilot status, has been in place not quite 5 years.
Yeah. Thank you. And I understand that one of your main concerns with the current version of the EBA is that there is no sharing mechanism, as I understand it from your testimony.
My current concern is that without a sharing mechanism, I believe that the company's incentives are misaligned with customer incentives, and that at times they align, and at times there are competing priorities, and shareholders' concerns take precedent over what's best for customers.
Okay, and we're going to get into that in a minute, but I want to first focus on this, what comes up mainly in your rebuttal and surrebuttal after the division filed its testimony about the possibility of eliminating the EBA. Throughout your testimony, you had what we've already referred to as a Russell dialogue with Rocky Mountain Power witness Ramon Mitchell on many topics, but you never disputed his assertion that every state in which electric utilities have not divested their generation resources has adopted some form of an automatic adjustment clause like the EBA. You agree with that?
No. What I stated in response to Mr. Mitchell's discussion of automatic adjustment mechanisms was I thought that it was high level and that it belonged better in a new docket where the kind of information that Mr. Mitchell was providing, as well as some of the points that Ms. Stewart made in her rebuttal testimony, would be best considered in a new docket. So it wasn't that I didn't respond to it, it was that I thought it more appropriately belonged in a new docket.
Let me rephrase the question because I don't think that's what I was asking. If the commission were to abolish the EBA, do you dispute that Utah would be the only state in which such a mechanism does not exist apart from states where utilities have divested their generation resources?
I haven't looked at those materials myself, and I haven't done the research, but what struck me when I read that was there's a difference between states and utilities. And so the question that popped up in my mind when I saw Mr. Mitchell's testimony on that point was to wonder, I might wonder how many utilities within a state are covered, have those types of mechanisms. And so that would be a question to me that I would think belonged in a new docket.
You have not, in your testimony, undertaken any analysis of what impacts such as a step, meaning eliminating an EBA or that type of mechanism, would have on the company's commercial or credit relationships. Is that right?
That is right. That is why I suggested we should open a new docket, because I thought that would be the appropriate place to evaluate that.
Okay. Now, in your summary, if I may have misheard you, but I thought you said that you hoped that the conclusion of such a docket, as you're envisioning, would be reinstating an EBA with a 70-30 sharing band. Is that what you said you hoped would come eventually of that?
Yes, and I think that I even said in my direct testimony at some place that I thought that the 70-30 sharing mechanism appropriately balanced customer and shareholders' interests, gave shareholders a financial incentive, which is one of the things that the commission that authorized the EBA felt was important in order for it to determine that it was in the public interest. That commission that authorized the EBA in 2011 specifically stated that the company's proposal that did not have a sharing mechanism could not be considered to be in the public interest for all of the reasons that had been developed in that 2-year docket, in that 2-year proceeding.
I guess in asking the question, I was just drawing a distinction between if you had a magic wand, and I know none of us does, but your preference is such a mechanism with sharing bands rather than elimination of such a mechanism.
I think that is my preference, yes.
And is that because the WRA recognizes that there in fact are some benefits to such a mechanism?
Yes.
I recall in previous testimony you've given, but I don't know if I recall it here, so I'm going to ask. You've indicated that the EBA, in the WRA's view, reduced the company's incentive to invest in renewables. Is that a position that you've taken in this case?
It is not.
Okay.
Well,
Now, you agree with me that the company does not earn a return on the charges that pass through an EBA. Is that right?
yes. Well, there's interest that's carried on the deferral.
Okay, let's talk about that. I was going to jump to that later, but let's mention that now. I know that you initially proposed eliminating the carrying charge, but you've now modified that to say reduce it to a nominal, like 0.1 or some percentage like that, correct?
A minimal amount because I became aware that Utah statute requires a carrying charge.
You don't dispute, though, do you, that the carrying charge is actually intentionally set at a rate that is an equivalent to the company's own borrowing cost to finance those expenses, do you?
No, I don't dispute it, and my rationale for reducing it in the way I do is included in my testimony.
Okay. So you would agree with me, though, that if there was a prudently incurred cost that was not in base, that had to pass through the EBA, and the company had to finance it, and their carrying charge was reduced, that there would be a financial penalty for the company for no wrongdoing?
I agreed with you right up until the end. So I will agree that it's prudently incurred. The idea was to create a financial penalty. So yes, I do agree there would be a financial penalty.
Okay. Now, one of the things that you mentioned was this misalignment of interests and shareholder interests, and your contention that the current iteration of the EBA creates potential for misalignment. Wouldn't you agree with me that because, as you've acknowledged, that the company does not earn its ROE on those costs, but in fact earns ROE for generation resources that it builds, that the company, that the regulatory structure already incents the company to build generation when the forecast would support it, because that's how it earns its ROE.
I would agree that under certain circumstances, customer interests and shareholder interests are aligned. And that is an example when it is in shareholders' interests to take on, to do those things that protect customers. My concern is when there are competing priorities in front of the company, such has arisen with wildfire liability versus continuing with the resource acquisition plan that was halted. And then you have competing priorities. You have shareholder concerns to want to maintain credit scores against customer interests, which is to reduce market risk exposure. And those require completely different expenditures. And at that point in time, you have shareholders, the priorities reflect shareholder interests. So back to your question, I do agree that there are incentives for the customer, for the company to build resources because you earn a rate base. But there are also times, as I spoke about extensively in my testimony, where the company might wish to delay for other reasons, like when there's industry uncertainty and you want to take a pause and figure out what's going on. That was in my testimony. We heard that in testimony here in the last week. Other reasons why the company might not want to build would be if it feared interjurisdictional allocation risk for some particular resource. It might prefer to delay that resource, and there are the times when there are different financial priorities for the company.
Okay, you in that answer referenced a few things that I'll try and pivot to, being cancellation of the 2022 all-source RFP is one. But before we do that, it strikes me that when you were giving examples of the company or shareholders, having concerns that don't apply to customers, one example that you gave was worrying about their credit rating. Wouldn't you agree with me that if the company's credit rating sinks to a place that its borrowing costs increase, that becomes a customer concern?
No, I wouldn't. There's been plenty of testimony over the last week that suggests that is much more of a shareholder concern, that is a direct shareholder concern. The direct customer concern is the high costs of short-term market transactions that have been growing, and those get passed right on to customers. So I think for customers, the greatest risk is relying on the short-term market, not the concern over increased borrowing costs.
Okay, let's talk about the cancellation of the RFP. I will, for brevity's sake, note but not get into the back and forth between you and company witness Link about all the different events that were going on that led to that cancellation. But I think I heard you say that, in your opinion, one of the major causes of that cancellation was wildfire risks. Is that correct? That's what you surmise?
1 minute, and I'd like to refer you to the language that was in the notice of suspension. And that's in my direct testimony, and I'll look for it there. Well, I'm not immediately finding it, but, oh, here it is. All right. In the notice of cancellation,
Sorry, what
so
page are
I'm,
you
I'm
looking
at, I'm at lines 501, on to 530. That discussion that I have there in answer to the question, what is the basis for your claim that financial considerations drove the cancellation of the 2022 all-source RFP and not changes in the planning environment? So that discussion begins at 499 and ends at 530. But in that,
Well, can I focus your attention then, looking at the language you've identified here for us? You point out on line 513, going on to 514, and this is a quote, instead the company focused on, quote, wildfire risk and associated liability, quote, and canceled nearly $1.5 billion in planned expenditures to support its credit rating. You see that sentence?
yes, but ahead of that sentence, I was bringing you to the language of the suspension. And the suspension had 4 bullet points for why the RFP was being suspended. And the first 2 mentioned EPA actions, and then there were 2 more. One was wildfire risk and associated liability across our 6-state service area and throughout the West. And the 4th bullet was evolving extreme weather risks that necessitate further decision-making regarding Pacificor's operational and resource requirements. And what I point out are these are competing priorities. They both call for the expenditure of funds. And the response by the company was to, as I quote Ms. Koblia stating, Pacificor has adjusted its capital investment plan over the next 5 years, reducing the planned expenditures in 2024 through 2026 by nearly $1.5 billion. That's the 2022 all-source RFP, when compared to previously forecasted amounts. In addition to reducing the capital spending, which increases the credit metrics, the company has refocused its capital plan in the next 3 years on wildfire mitigation expenses to reduce the risk of wildfire events and on investment in the ongoing safety and reliability of the service. In addition, the company has adjusted the timing of its investment that are required to continue to transition to clean energy resources and renewable resources. The adjustment in the timing of these investments will provide better support for the company's financial profile in the short term.
Okay, Ms. Kelly, I don't think I'm saying anything different than you're saying. I'm trying to just focus that you criticize the company, or in this case, Ms. Koblia, for focusing on mitigation efforts and expenses to reduce the risk of wildfire, and say that's an example of the company focusing on its own priorities rather than customers, correct?
I disagree with the word criticize. I have stated all the way through that it is rational behavior on the part of the company when there are different incentives and the incentives aren't aligned. What I am trying to demonstrate here is that there are competing interests. There's the interest of customers to reduce market reliance, and there is also the interest, and I would agree that it includes customers, but is not felt by customers nearly as immediately as the cost of increased market reliance, and that these are competing priorities. And that's it's not a criticism. It's meant to be an observation and a demonstration of when and how customer interests can become misaligned. And my question is, I don't know what you would do. I don't know if you know what you would do if you had a 30% stake in net power costs exceeding base net power costs.
Okay.
Well, not you, I know your client.
If I could just say, though, I'm not talking about that. My question that I'm trying to ask is simply whether you are taking the position that the company focusing on wildfire mitigation, is it your position that that is focusing on itself, or do you agree that that's beneficial to customers?
I'm not taking a position. I am demonstrating a difference in incentives.
I don't have any other questions. Thank you.
Thank you.
Thank you, Mr. Moskin. Ms. Hayes, do you have any redirect?
I don't.
Okay, and I assume no one else has any questions of this witness. We'll go to Commissioner Harvey.
Hello.
Hello, Commissioner.
I'm recalling correctly, you have been involved with the IRP stakeholder processes for quite some time.
Back to RMP 6, 1998.
Okay, so even farther than I thought. That's impressive. All right. In your summary, you mentioned an increase in the amount of FOTs that were used to meet total requirements from 5 to, I think you said 13.7%?
I would have to check my number. That sounds right to me.
My question wasn't the exact number, but what was the time period? I missed the time period. And I
In
apologize.
between the two GRC net power cost filings.
So just between the.
So 2021 test year to the 2025 test year.
All right, thank you. And then you observed, both in your testimony and your summary, that one of the major causes of the EBA increase is related to the volume of FOTs versus just the price increases that have been cited elsewhere.
Yes.
Will you explain your analysis that separates those effects in terms of how you did it?
Yes. So in the two net power cost filings, you have can I direct you to an exhibit? So if you look at exhibit NK2 corrected, you see the components of net power costs that are included in the company's filing that the Aurora model uses on the top above the blue line, and you see the volumes of megawatt hours below the blue line. So what I did was, in another exhibit, I calculated the dollars per megawatt hour so that I had that number. And I believe that is in
I'm okay, you can.
okay,
just tell me. I'm
that's
interested mostly in the-
exhibit NK6. But anyway, so what I did was I did it in 3 steps. I calculated the total net power cost increase, the dollar amount resulting from the higher volumes and the higher prices of the total short-term firm purchases and the total system balancing purchases. I added those together for 2020. I added them together for 2024, and I looked at the difference, And that total increase was $708 million. And then what I wanted to do was I wanted to break out the price effect. And so I took the megawatt hours from 2020, I adjusted them upward for load, and then I multiplied those megawatt hours by dollars per megawatt hours, and I came up with 446.4 million. And I subtracted that number from the total of 708.6 million, and I came up with the effect of market reliance as 262.3 million.
Okay, thank you very much. Appreciate that. In your, I think it was summary, but it may have been cross, you mentioned a statement from a company representative that it would have been reckless, quote unquote, not to acquire resources, referring to the earlier IRP. Do you remember that?
Oh, that actually was a statement by Mr. Link in his rebuttal testimony, and it was a statement he made in his summary, and what he had said was that it would have been reckless for the company to procure the resources that were in the 2022 all-source RFP ahead of their need, is what he said. Okay. And so I was just picking up on his terminology of downright reckless, because it is my understanding that that need remains, and it is going to be met with short-term market purchases. You heard Mr. Wilding's description of all of that and the increase in the need. And that is where the big cost increases are in these categories of costs. The costs of long-run purchases have gone down. It's these short-run purchases that have had the skyrocketing prices. And you can see that in my corrected, you can see the percentage increases by category in K2 corrected.
All right, a final area. Can you please explain from your perspective, and I admit you've done this to a great extent already, but just kind of concisely for me, why the long-term interests of shareholders and ratepayers are different? That's the first part. And then the second, how the current EBA structure influences those differences.
So I would begin by saying that the company's obligation is to its shareholders. And customers' interests are in receiving affordable power and good service. And I do go into some detail of this in my testimony, and I would also say we went into some detail in the 09-035-15 case. And the result of that was the commission determining that it was important to maintain financial interest. But I can more explain situations. Let me look at my direct testimony and see how I describe that there. I guess my response is that that meeting customers' need at the least cost isn't always what is in shareholders' best interests. And there are times, as I said, when they align, and then there are times that they do not. And I would say that the increase in market reliance, even as market prices are increasing, is evidence of a misalignment. That is a question that I can't succinctly answer. So my apologies.
Oh, I think you got the gist of it. That's fine. That's all I have. Thank you.
Okay.
Commissioner Clark.
I don't have a question for you, but thank you, Ms. Kelly.
Thank you.
Great. I don't have any questions, Ms. Kelly. Thank you very much. You can be excused.
Thank you.
Oh, yeah, no, that's great. I think we're done. I thought I thought you were looking at me to say something, Ms. Hayes. Okay. All right. I misinterpreted that. I thought I was getting a signal to want to say something. Okay, so I just want to talk for just a second. We were scheduled to have Mr. Boothman, and just looking through his pre-file testimony, there are issues that will be coming up in phase 3 with respect to his testimony, and I guess I'm trying to figure out what your preference is. First of all, I think we need to hear from you whether you want to do Mr. Boothman this evening, or should we do this on Monday?
My preference would be to hear from Mr. Boothman right now.
Okay.
But I'm fairly certain he's available on Monday.
What about the rest of you? A long week.
If it helps inform the decision, the company was planning on reserving its cross until the future phase. So if we did him today.
Okay, so all we have is his summary today.
Correct.
Let's do that. Okay. That helped.
Western Resource Advocates will call Carl Boothman.
Mr. Booth, yeah, don't trip. Mr. Boothman, welcome. Would you raise your right arm? Mr. Boothman, do you solemnly swear the testimony you're about to give in this matter pending before the Public Service Commission of the state of Utah shall be the truth, the whole truth, and nothing but the truth, so help you God?
I do.
Thank you. You may be seated. So can I just ask a clarifying question? He does talk about the ICA, and he talks a little bit about REX, and then commercial insurance issues, as well as the excess liability insurance. And I assume his summary may cover all of that, and that's fine. Okay, but even if there's issues involving REX, you don't have to intend any cross-examination today, is that correct?
Correct.
Okay, all right. Please proceed, Ms. Hayes.
Thank you, Mr. Chair. Good afternoon, Mr. Boothman.
Good afternoon.
Will you please state and spell your name for the record?
Yes, my name is Carl G. Boothman, Karlg Boothman.
By whom are you employed and in what capacity?
I am employed by Western Resource Advocates as a senior policy advisor. I provide policy analysis and regulatory support to WRA in electric industry-related matters.
Have you previously testified before this commission?
I have not had the pleasure.
In light of that, will you please provide a brief overview of your education and previous work experience?
Sure. I have a Bachelor of Arts degree in economics, conferred with distinction from the University of Michigan. My condolences to your Buckeyes. I guess that curries me no favor today with this commission.
Oh, you were really on thin ice now.
I didn't wear my maize and blue tie today, but I thought about it.
Thank you for that.
From 2013 to 2016, I was employed as an analyst with Applicon LLC, a consultancy based in Ann Arbor, Michigan, where I provided econometric and qualitative support in litigation related to antitrust, collusion, and price fixing. From 2016 to 2019, I was a consultant, and from 2019 to 2022, a senior consultant with 5 Lakes Energy LLC, an energy policy consultancy based in Lansing, Michigan. In that role, I provided policy support, analysis, and expert testimony for clients on a range of topics in the energy industry, including but not limited to cost of service and rate design, energy siting, integrated resource planning, and economic dispatch modeling. I've been in my current position with WRA since 2022. In addition to my formal education and work experience, I've completed multiple professional development courses in utility accounting and rate making, the annual regulatory studies program at Michigan State Institute of Public Utilities, as well as cost of service, rate design, and depreciation courses.
Pardon me. Did you file direct testimony along with exhibits KB1 through KB4 in this docket on October 17th?
I did.
Do you have any changes or corrections to that testimony?
No.
If I asked you the same questions today, would your answers be the same?
Yes.
I would now move the admission of the pre-filed testimony and exhibits of Mr. Boothman.
Without objection, we will receive those into evidence.
Thank you. Do you have a summary of your testimony for the commission?
Yes.
Go ahead and provide that.
Good afternoon, Chair Fenn, Commissioner Clark, and Commissioner Harvey. In my Phase 1 direct testimony, I addressed 2 distinct company proposals, the Insurance Cost Adjustment Proposal, Schedule 92, or the ICA, and the Voluntary REC, or Renewable Energy Certificate, Option Proposal, Schedule 74. I understand that the Commission has moved the amount of excess liability premiums to Phase 3. However, my testimony addressed the policy factors relevant for approval or disapproval of the ICA, which I understand remains a Phase 1 issue. In my Phase 1 direct testimony, I argued that collection of excess liability insurance premiums through a dedicated surcharge, like the ICA, is unsupported by any novel issue in this proceeding that would justify single-issue rate-making treatment. When determining whether a balancing account is warranted, cost escalation should not be conflated with cost volatility or uncertainty. In other words, increasing costs are not a sufficient justification for an additional balancing account. Instead, I argued that strictly rising costs are a strong justification to keep cost recovery in base rates and preserve regulatory lag, the primary incentive for utility cost management between rate cases. Regulatory lag also provides a significant incentive for the company to imminently evaluate and file for its forthcoming insurance mechanism, which may include lower cost self-insurance. Next, I questioned whether the analytical rigor that underpins the company's insurance procurement has increased commensurate with the rise in insurance premiums. I showed that the company has not conducted its own study to approximate statistically expected losses for the test period, does not have a methodology or mathematical method to determine reasonable liability coverage for each of its states, and has not compiled a comprehensive list of Western wildfire claims, despite describing such a list as a main determinant used to arrive at the reasonable level of insurance. Instead, the company repeatedly stated that it simply procures the limit of insurance offered in the market and believes that limit to be prudent. This circular procurement strategy presented much less risk to ratepayers when premiums were around $2 million on a Utah allocated basis, which they were as recently as 2020. A $90 million increase, roughly, suggests that the commercial insurance procurement process should be scrutinized. I argue that the prudence of insurance procured in an increasingly concentrated and dysfunctional commercial market can no longer simply be assumed prudent if the company has been aware to potentially lower cost alternatives to commercial wildfire liability insurance. These alternatives, by this I'm referencing self-insurance or other mechanisms, can be considered substitute products to commercial liability insurance. These mechanisms and approaches have also been undertaken by peer utilities in jurisdictions with similar wildfire risk. The company's inability to describe its method to determine the amount or cost of prudent coverage is problematic, and the presence of an adjustment clause for commercial liability insurance premiums may diminish the incentive to timely propose an alternative. Finally, if commercial insurance costs were recovered outside of a general rate case, it may preclude or hinder the ability of stakeholders and the Commission to evaluate costs holistically given interacting effects with prudent insurance levels. For example, vegetation management, power shutoff policies, and grid resilience investments, as well as legislative developments or regulatory support, should ostensibly impact the company's state-specific statistically expected losses and overall risk profile in a given year. Accordingly, my recommendation is that the Commission reject the company's ICA proposal in this proceeding. On the voluntary REC program, the company has proposed a voluntary program by which it will retire rather than sell RECs on behalf of participating customers to match a certain percentage of those customers' load in the preceding year. I provided 3 recommendations pertaining to the specific tariff and program language. The company adopted these recommendations as outlined in the red line tariff in Mr. Eller's rebuttal testimony. Also, the company's proposal of a 3-year pilot program with a stakeholder process to be initiated in the final year of the program should reasonably allow for stakeholder involvement on program performance and potential expansion to other Utah customer classes. Therefore, I find the company's proposed program satisfactory. This concludes my summary.
Thank you. I assume that means we have nothing else for today. We'll be in recess until 9 a.m. on Monday morning.
Mr. Chair,
Oh,
it's Captain George. Hi. Just,
sorry, sure.
I don't know if you,
I
we
was
need to
just,
do it
I
on
was
the-
just so anxious to get out of here. I didn't even,
I
didn't
am-
even
I am-
look around to give you a chance. I'm
I
sorry,
am too,
Captain
which
George.
is the point of what I'm about to bring up. Given the fact that FEA does not have any additional cross for any of the remaining witnesses next week, I was wondering if it would request respectfully to be excused for the for my appearance for the remainder of the next week.
You made a respectful request, and we will grant it.
Thank you. Much appreciated.
All right.
It's been wonderful being here.
It's been wonderful to have you here. Thank you for your participation, Captain George.
Thank you.
Okay, with that, so how hasty I was, does anybody else have anything that they want to raise? Oh, okay, Commissioner Harvey, he has a few more questions he'd like to ask. Oh, go ahead.
I'm going to be very quick.
Oh, you want to ask him questions? I thought we were going to wait till phase. If Moss can wait till phase 3, why couldn't you? I'm sorry, and I put all that on the record too. I apologize. Please, we'd like to respectfully turn the time over to Commissioner Harvey for some questions.
You mentioned you would like to see the company come up with an estimate of expected losses. Is that correct?
I think that would be a reasonable calculation to do given the rising cost of commercial insurance and the fact that the company procures insurance through a broker, and the number of commercial insurance providers in the marketplace is shrinking. So yes.
Now, given the relatively long history of modest losses, the one-off nature, hopefully one-off nature of recent losses, how would you expect the company to go about developing such an estimate?
That is a great question. I think what I would like to see is perhaps a little bit more communication within the company between its operational staff and perhaps its financial or insurance staff. I think that what I would like to highlight, and what I think I did highlight in my summary, is that the presumption that wildfire mitigation efforts, for example, work or are effective should, like I said, ostensibly decrease the expected losses in any given year. Further, there are other mechanisms like SB 224 that limits non-economic damages. Those mechanisms, if they are put into place in between commercial insurance renewal periods, I think those should be reflected, and there should be a way to quantify the effect of such efforts or legislative support or regulatory support.
Thank you.
Yep.
I I've checked with Commissioner Clark. He has no questions. We will stand at recess until 9 a.m. on Monday. Thank you, everybody. Have a wonderful weekend.
Thank you.
Thank you, commissioners.